Do you know what Wonder Bread is?
No.
You didn't grow up with Wonder Bread.
No, what is that?
Wonder Bread is a white, spongy, I mean, help me here, Lisa. It's like kids' bread.
It's basically like inflated plastic that you can eat. So you can basically...
That's accurate.
Do they slice it for you?
It's pre-sliced, it's packaged, and then basically you can mush it into different shapes if you want to eat it that way.
But that's the distinction, John. I'm making my stuffing with Wonder Bread, and Martha's got Italian
So it's like Play-Doh.
Except that you can eat it.
So
that would be
edible
accurate.
Play-Doh.
Play-Doh.
Okay. Let's get to foreign exchange. No idea where that was going. The euro pulling back just a touch yesterday. 2 days of it now. We're negative 0.1%. Small move there, though. We're backing away from August highs on the euro against the dollar. 109.03 TK on that currency pair right now.
And not talked about enough is the ascent of sterling, 125.32. I mean, over the last X number of weeks, what was it, 119, 116? We were getting down there. And I mean, I'm sorry, it's been an actually constructive pound sterling around the underestimation through all of 2023 of the resiliency of the United Kingdom
Might be getting
economy.
some tax cuts a little bit later as well.
Yeah.
Just for our audience in the United Kingdom, you will have full coverage of that led by our team out of London. I believe that starts in about 45 minutes' time.
Oh, good.
That's the story of the FX market, Tom. We need to talk about jobless claims in about 2 hours' time. I think that's absolutely critical for this market. Just to go back over what we've been talking about over the last few days or so, there is a difference between a welcome loosening of the labour market and an unwelcome deterioration in the labour market. And Tom, claims is going to be part of that story in the weeks and months to come.
Yeah, to me, the research item, and when we talk and listen and read market economists, is what is that 4-week moving average number on weekly claims? And the answer is, A, I don't know where it is, but we're like a 220. And is it 250? Is it 280? A worser, higher number? Where's the trip point there to get to that unwelcome?
I take your point. Just in general, when is that trip point where it becomes something that suggests a non-linearity and a greater weakness than just a Goldilocks kind of soft landing?
We're nowhere on non-farm payrolls. We're nowhere there.
No. 2 Fridays away, I think, non-farm payrolls.
No,
a couple
but
of weeks
with a
away.
survey number, we're nowhere near an equivalent claims number of, say, 280 or 300.
Yeah, I didn't mean on the calendar, nowhere near it. I meant sort of like, you know,
why don't you do
that's what it is.
2 garlic cloves minced.
Under surveillance this morning, here's your top story. A ceasefire in the Israel-Hamas war. Hamas agreeing to free 50 hostages from Gaza in return for a 4-day ceasefire with Israel and the release of 150 Palestinian prisoners. It'll be the first pause since the war began in early October, with Israel saying the pause in fighting will be extended by a day, Elisa, for every additional 10 hostages released.
We have to just start by saying, honestly, if this happens, what wonderful news to get the hostages home, children, babies, and get them back with their families. Also, how great to have the bombing stop for the children and families in Gaza. Where does this leave the conflict? What happens during those 1, 2, 3, 4 days? How fragile is it that it potentially gets broken down? And then how do we end this?
The video we just saw, for those on radio, house-to-house searching by Israeli forces, and I would go to where General Kimmett was yesterday with Bloomberg. John, it's just about every house, step by step, and that's an ugly war.
It's a really rare positive development in the war of the last 6 weeks or so. Got to turn to the most tedious story of the year so far. Fired Friday, hired by Microsoft Monday, back at OpenAI on Wednesday. Sam Altman returning to the company he founded just days after being fired. After nearly all of its employees threatened to quit if he wasn't reinstated, the company also agreeing to overhaul its board with new directors, including former US Treasury Secretary Larry Summers, who of course is a Bloomberg contributor. Is that the final chapter of this saga, Bramo, or is there more to come?
My favorite was that the graphic couldn't catch up to what you were saying, because it was just so many different things and different moments.
It's happened so quickly.
It's happened so quickly, and that sort of speaks to where we're at. Is it the final chapter? No. To me, this is not the final chapter, because what is OpenAI? Is it a nonprofit? Is it not a nonprofit? Have you looked at its corporate structure? It is very difficult to understand. And then there are these highfalutin aims. Is there a concern about the safety of artificial intelligence? Have they resolved that concern?
This is about a new clarity of Microsoft developing, I believe it's 2 chips to catch up and beat NVIDIA. That's all this is about. It was laid out 10 days ago before all this Altman soap opera. They're just out there. Everyone, Amazon, Google, all of them are just trying. Mark Benioff at Salesforce.
Sure, yeah.
I don't even know what he wants to do.
Trying to recruit, that's what he's trying to do.
But the answer is this is about catching up to NVIDIA on this, what Satya Nadella told Emily Chang is a mega business.
Well, let's get to NVIDIA. Shares turning positive. After another strong quarter, which saw the chip makers' revenue comfortably beat estimates, the company also announcing new chips designed for China, saying US restrictions on exports to the country could negatively affect income into next year. The stock now positive by 1.3%. It's a 240% plus gain year to date. Lisa, it's amazing these numbers that come out of this company.
It's like a kid who gets A+, and then they get like an A. And people are disappointed, and they're, why didn't you get the 100? I mean, that's kind of how it feels.
I keep going back to that Julian Emmanuel line from Evercore, and this was before the release of these numbers. In the near term, great isn't always good enough. That's what it felt like after the close yesterday. I want to finish on Europe. Over in Europe, the ECB is warning that sluggish growth is threatening to amplify risk to financial stability posed by higher interest rates. The ECB Vice President, Luis de Guindos, speaking to Bloomberg after the release of the bank's biannual financial stability review, saying markets are too optimistic.
This is one of the main risks, because now the outlook that markets are taking with respect to the evolution of the economy, I would say that it's a little bit sanguine and so optimistic, and there is a little bit of wishful thinking.
A sober message coming out of a central bank, TK. A bit of wishful thinking over at the ECB.
Yeah, Lagarde riding herd with the Bundesbank 2% as well. I don't hear any navel-gazing about 2 to 3% here at the ECB. And they can do this because supposedly they have a lower nominal GDP set than the U.S., but there is a distinction here on where we're heading.
These guys aren't celebrating.
Yeah,
that's the takeaway. ECB, BOE. Catherine Mann yesterday.
I missed that.
In the Bank of England this week, Treasury Select Committee, talking about more interest rates. She'd like to hike even more.
Oh, yeah.
That is like the hawk in developed market central banks right now.
And what's so important there with weak global GDP, a la Bruce Kasman, is Dr. Mann has literally invented the codependency thinking between China and the U.S. So she's hugely qualified on a global basis. Also qualified is Neil Shearing, Chief Economist at Capital Economics Group. Neil, let me just cut to the chase. Are we going to see global recession?
Depends how you define a global recession. I think if you look at most definitions, it's global economy grown by kind of less than 2.5% to 3%. I think by the year on year, by the time we get to the first quarter of 2024, I think we probably will meet that definition. Yes. But of course, it's all in the definition, and it depends on which countries you're talking about. And really, the key point about recessions, I think, is this element of reflexivity. So you get weaker demand feeding into higher unemployment that creates another feedback loop into weakening demand. That's only then broken by central banks or governments loosening policy. I think that's a very real prospect in Europe and indeed the UK. Perhaps less of a threat in the US, perhaps a bit more 50-50 in the US. But certainly, I think we're going to be entering 2024 on a substantially weaker footing.
So let's talk about, Neil, the way that central banks could end up getting involved, given the fact that ECB's Luis de Guindos was talking about the elevated chances of some sort of financial accident with high rates and a slowing economy. Will there be a trigger that will force much bigger, deeper cuts to rates, both in Europe but also in the U.S.? Or do you think that we're going to be able to just sort of have this glide path that people are currently mapping out?
Well, I think it's possible in the case of the US. I think the situation today is far more analogous with the situation after the Second World War, where you have this enormous supply disruption and then high inflation. That is the case, then there's the comparisons with, say, the 1970s, which some people have made. So if you take some comfort from that, it's that inflation was high for a few years after World War II, but then came down quite sharply in the late 40s, early 50s. And that would mean that central banks would have some scope to loosen policy. I think that's a far more plausible set of circumstances, particularly in the US, than is perhaps the case in Europe. Now, what would cause central banks to loosen policy? It's possible that some kind of financial crisis event might occur. But if you look at the response to SVB in the US, if you look 12 months ago, the LDI crisis in the UK, that didn't deter central banks from hiking interest rates. They used their open market operations to ease financial market tensions, but they didn't loosen policy. So it needs to be a pretty catastrophic crisis, I think, for them to be forced into really, really loosening policy. More likely, I think, is that we get cyclical downturns, particularly here in Europe, probably also in the US too, and that leads to some loosening of policy from probably the second quarter of next year.
One of the key sort of aspects behind this is why we've seen disinflation to the degree that we have so far. Is it because of simply year-over-year comparative data points, or is this because of some of the tightening that's already come to pass? In other words, is that downturn going to be disinflationary enough for central banks?
This is the great counterfactual, and it's the thing that we're always up against in macro, isn't it? Is what would have happened had central banks not have tightened? And my guess is that actually inflation would have come down anyway. And that's not to say that monetary tightening has had no effect. I just think it explains a relatively small part of the disinflation that we've seen so far. Most of the disinflation we've seen so far is about the unwinding of those pandemic-related distortions, particularly on the supply side of economies, and the economy kind of becoming the demand supply within the economy is becoming closer in equilibrium as a result.
Neil, thank you for that. Neil Sheeran there of Capital Economics. Just to extend what Neil's talking about there, TK, of the disinflation we've seen so far, it's just about a rebalancing led by the supply side. Then what's in store for 2024 is why some people think that the damage that's going to be done by higher interest rates is still in our future, and we haven't recognized it just yet.
Yeah, it's the phrase I hate, long and variable lags. So you get out the damage to, 4th of July of next year. But this supply versus demand side of the economy is fascinating, and I don't really know what to make about it. I got two issues here. I got Bruce Kasman and his team at JP Morgan really thinking about this, and Kasman's got a first half global GDP shockingly under 3%, really stunning, 2.1%, John, doesn't get it done. Or do you take an IMF stance, which is out to 2028? Pick your gloom, but you got short-term modeling and long-term modeling that's challenging.
Brace yourself.
NVIDIA doesn't care.
Deep breath. Up next on this program, we'll be talking about open AI with Mandeep Singh of Bloomberg Intelligence. We'll also throw in some NVIDIA earnings in the mix as well, so hopefully we can avoid soap opera of the last few days. What did Kara have to say?
Kara Swisher, a long tweet, it's fabulous. A demented goat rodeo.
I think we're all on board with that. What a mess.
Perfect. It's just, it's what it is. Maybe.
Tech journalists pulling all-nighters, trying to figure it out, Bramo. They can sleep easy now.
Yeah, have we figured it out?
No. Still trying to work out why it was fired in the first place.
Exactly.
I know, it's absolutely ridiculous. The latest from Bloomberg Intelligence, Mandeep Singh coming up next. Equity futures right now just about positive 0.1%. Live from New York City, this is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside? This is Bloomberg.
here today to announce the Treasury Department's historic action, the largest enforcement action in Treasury's history against Binance. It deliberately undermined its own sanctions monitoring controls, and it failed to report suspicious transactions.
The Justice Department is requiring Binance to pay $4.3 billion in penalties and forfeitures.
That was U.S. Treasury Secretary Janet Yellen and U.S. Attorney General Merrick Garland announcing a record fine on cryptocurrency exchange Binance for violations including ignoring sanctions and a failure to report suspicious activities. TK, one of the biggest players in this space, and another one bites the dust.
Did you see this coming? I did not see this coming.
You've been talking about it for months.
I've been talking about this is going to happen, but I did not see this coming on a Thanksgiving Wednesday. Ken Rogoff, my book of the year 5 years ago, The Curse of Cash. Professor Rogoff got legitimate death threats off that book, and it's about what Raphael Auer at Bank of International Settlements has talked about. It's about criminal activity.
Which raises this question: if the first two biggest exchanges for cryptocurrency have both been implicated in some sort of fraud, well, you know, what else is going on? And I just wonder, especially given that some of the payments for certain terrorist organizations were facilitated on these exchanges.
I'm not going to mince words. Team surveillance, and Pharaoh's been a piñata on this, is we have been skeptical about this ballet from day one. And I was shocked. I did not see this coming, and I was shocked yesterday. They must have evidence on this guy. I can't, it's inappropriate to comment on it, but I was stunned at a $4 billion fee.
Well,
Merrick Garland standing there with Secretary Yellen. Ken Rogoff looks like a genius this morning.
So, Tom, what's next?
What's next is I hope there's some sobriety among institutions. It takes long to do this, but what is the institutional value of crypto? It's not for me to say what it is, but everyone has to study that with a new humility.
I don't think it goes away. I think it goes towards traditional players. Isn't that what's next? You stop talking
Aren't we
about
gonna have
FTX.
ETFs?
You stop talking about Binance, and you start talking about BlackRock a little bit more.
What does BlackRock do? Do they want to be associated even tangentially on an ETF to what we witnessed yesterday? I don't know.
To John's point, the fact that you've seen Bitcoin hold in its value as much as it has, despite some of this news, points to a stickier, more institutional, less day trader type of audience, which means it has a very different type of use and investment case than maybe some of the earlier prognostications.
And could well go towards stronger hands. I hate to use the phrase "the adults in the room," but you know that's a phrase that will be used.
I can't disagree with you, but I just think that we have led on looking at the research and seeing what smart people think about this, including Professor Rogoff at Harvard. Let's move on from that, and there'll be much more on that. Look to crypto on Bloomberg Television for that. What are we going to talk to Mandeep Singh about? Not stuffing.
Take your pick.
Like
You can have
NVIDIA.
OpenAI or NVIDIA.
Which would you like to go with, sir?
To be honest with you, I'd prefer to talk about NVIDIA because I think it's more material to
Let's
what's
do
happening
that
this
right
morning.
now. Mandeep Singh joins us here on NVIDIA and what we saw yesterday. What is the legs on this, Mandeep? I mean, you know, we all get the moonshot and units and the fervor, and I saw the 240%, blah, blah, blah. Do you look at it as a three-quarter thing, or can it be a 30-year thing?
I mean, look, we are witnessing the biggest data center expansion right now, and data center IT market was about 8 to 10% grower historically, and when you look at the numbers that NVIDIA is printing, clearly there's insatiable demand. Yes, they will be affected by China restrictions, but they're still under shipping demand, and that was the message. And this is a near monopoly at this point of time. The question that you have to ask yourself is, will it remain a monopoly like Intel was over the last 25 years in the CPU market, or will there be more players that can develop chips? And right now, the customers that are buying these chips are very concentrated. It's the hyperscalers that are buying, 50% of NVIDIA's capacity. Will they continue to do that, for the foreseeable future?
Okay,
That's
well,
the question.
you're an expert on this, and I guess Altman's back at OpenAI. How long does it take to make a competitive chip?
Well, so that's what NVIDIA has showed, that they can pivot much quicker. They can ship products much quicker than anyone else. Look, AMD and Intel have the capability to make a GPU, but it's not as productive and efficient as an NVIDIA GPU is, and that's what we are seeing. That's why I say it's still a monopoly, and until you see proof that companies can train as effectively their models on alternative chips, I think NVIDIA will continue to have this kind of ASP growth, which we saw last night.
Mandeep, one aspect of the earnings report that I thought was probably most interesting was the drop-off they signaled in Chinese demand for their GPUs, for some of their products. And this comes at a time where they're still able to beat expectations on revenue. They can still ship those chips elsewhere. What does that tell us about both what's going on in China, but also more broadly, what's going on with just the glut of demand?
Yeah, look, there was certainly some pull forward in China because they anticipated these restrictions, and you could argue NVIDIA was probably over-earning in that region. But there is that demand, that they can ship their chips elsewhere, and that is what gives, I think, the confidence that this company is way ahead in terms of not only just developing a GPU, but bundling it. They highlighted networking is a $10 billion run rate business. Software is a $1 billion run rate business. They have the perfect mousetrap right now in terms of bundling these chips to train large language models, and that's huge.
All right, so Mandeep, we were talking about OpenAI and trying not to talk about OpenAI and the relevance of that to this story. How much is there a relationship in terms of Microsoft's desire to create some sort of rival chip with respect to the AI development more broadly, and what the future is for OpenAI as an independent agency?
Yeah, look, OpenAI and NVIDIA are the face of generative AI, if you think about the trend that has played out this year. And I think with OpenAI going through this turmoil, Microsoft driving those changes has steadied the ship. But I would be surprised if they can, ship out the next version of GPT as quickly as they intended to be, because there will be some talent loss as a result of this. And I think Sam coming back to OpenAI may drive some people out, and I can't imagine things will go back the way they were last week.
What do those people actually do, Mandeep? I'm serious. Do they sit at a desk with what? A Sun Spark station, a Mac? What computers in front of them? And are they doing the coding like the coders do at Bloomberg? Is it just as romantic as that?
I mean, look, this generative AI wave is built on a transformer model, and that is built on, ingesting large amounts of data. There is a human feedback element to train these algorithms and put those guardrails. And training is a constant process. That's what we learned from NVIDIA last night, that you're not one and done with training. You're constantly training your model. That's why you need the GPUs and the data center build out. So there's a lot that's going on in terms of understanding the algorithms, and then obviously putting the guardrails to make sure the results are correct.
Mandeep, just a final question from me, and certainly I would never criticize Satya Nadella. I think I've said on this program and in the last 24 hours, one of, if not the best CEO in corporate America, but clearly some missteps along the way here. Mandeep, what do you think the lessons of the last week will be for him and for Microsoft?
I mean, when you make a $13 billion investment and, take a 49% stake in a company, you take a board seat as well so that you know what's going on. I think in this case, they were blindsided by the developments, and he mentioned that. And clearly, I think that was the lesson for Microsoft here.
Mandeep, thank you, sir. Mandeep Singh of Bloomberg Intelligence. We've said a few times, Tom, this is not the way someone like Nadella does business, but a clear misstep, I think, on Microsoft's side, given what Mandeep just said.
And the little bit I read about this morning, they're saying this is a Microsoft victory. I'll let you explain how. But I do agree, the shock of this within the niceties of the foreignness of Seattle and Silicon Valley. I mean, just...
It's a victory because they're going to win no matter what. I mean, that's basically how it's going to work. They have a 49% investment. They win regardless. In this case, they get more control. They preserve their investment. And, oh, by the way, their AI capabilities have just been highlighted for 3 straight days.
But there's
now.
different
AIs, who have been
right?
up all night.
John, there's different AIs. I mean, there's ChatGPT, I get that.
Sure.
And Microsoft has Copilot. But, does Mark Benioff's AI need the same as Satya Nadella's? I don't think so.
What's amazing about this, to Lisa's point earlier in the hour, we still don't know why he was fired to begin with. And we're still trying to find out.
I still don't know what a large language model is. I mean,
Well, you got some reading to do this weekend.
Serious, I got to read in on that.
That'd be good.
Watching paint dry.
That bad?
Yeah.
Okay. Coming up, Jack Caffrey of JP Morgan Asset Management. That conversation just around the corner. Equity futures on the S&P 500. Positive here by 0.1%. This morning, we will have some important economic data. Jobless claims in America. 8:30 Eastern Time, about 94 minutes away. From New York City, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
So we get to ride in an Uber with the Uber CEO.
Yeah, that'd be pretty cool.
Come along with me, Emily Chang, as I ask tech leaders of today what makes their businesses future ready for tomorrow.
You're an expert. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You know, we think that eventually these interest rate hikes are going to have to bite more.
I don't expect the Fed to cut rates until the second half of next year.
Maybe the Fed is done. The notion of higher for longer, I think, is somewhat being lost on investors.
The economy moved slowly and inflation has come down. Personally, the Fed had very little to do with it.
There's also a chance that inflation, doesn't fall back to 1.5, that it gets stuck at 2.5 or 3.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We are thankful for equity market returns.
You're choiceful.
Live from New York City this morning.
No.
Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market positive by 0.1%. The bulls added force in the last 24 hours. Bank of America, 5,000 points. The target year-end on the S&P next year. RBC, Lori Calvasina, 5K year-end next year. Tom, month to date, the NASDAQ 100 up close to 11% in November alone.
Yeah, the acceleration's there, and again, the acceleration is there this morning. I'm looking at some of the luxury stocks, by the way, doing well. And you know, I wonder if it's a China pickup or it's all the excitement over NVIDIA and that. But people are recalibrating, reassessing, and there's, John, I would say there's this numbness, not to November and all to December, the Fed meeting there as well, the year end. There's a numbness about the complete total mystery of January and February, what it's going to be like.
I'm numb to the returns of NVIDIA. To the sales growth. We're talking about another double-digit percentage beat, Bramo, on a name where the bar just couldn't get higher, and they still keep skipping over that bar.
They keep skipping over it, and people are unimpressed because they're not skipping over it even more. They're not even actually doing better than people previously expected, which raises this really concrete question, and it's sort of this existential question for the rally we've gotten year to date, which is how much growth have we baked in that is or is not achievable? What are we pricing at this point when you see some of these gains?
The fancy existential question is simple. Are we going to see breadth? Coming out of 74, 75, we had a moonshot lift, and then we paused. And, you know, maybe we've paused here and, you know, coming off of October last year. But how do we get to a 1977 lift out to 1982 is the analog. And I don't think you can do it with the magnificent 5, 6, 8, 12, whatever it is. You need breadth, and that's the money question.
We've called NVIDIA the magnificent one, the #1 performing stock on the S&P 500, year-to-date up more than 240%. It's important to this market. It makes up about 4.6% of the NASDAQ 100. It's the number 4 weighting. The number 4 weighting on the NASDAQ. Also, I think number 4 weighting on the S&P 500. What's important to this economy is the data point, Lisa, that comes at about 8:30 Eastern Time.
How quickly?
It's 90 minutes away.
Yeah, how quickly the labor market is going to roll over, and that's really the key question we've been asking it all morning, which is what's the distinction between a Goldilocks slowdown and a more protracted kind of downturn? I will also add to that, is disinflation good for corporate profits? Is that good for employees if they're not seeing the commensurate wage gains? And we're seeing that in some of the earnings, that maybe it gets a really kind of to be a complicated picture.
We should revisit a question we've asked in the last few weeks. The labour market no longer a reason for this Fed to be hawkish. Is it now becoming a reason for this market to be bearish? Are we at that inflection point? How close are we to that with jobless claims?
Michael Collins was saying he thinks that we are much closer to that inflection point than risk assets are pricing in. Most people who have come on this show have pushed back and said we still see people grinding through this, getting to 5,000. People are feeling good. The sentiment surveys are coming out positive. And that seems to be where we're at.
Very soothing there, Bramo. I have to say, if you've been away for like 3, 4, 5 years and you looked at where claims were, they're still incredibly low.
But it's the trajectory. And we've been talking about that. And the fact that you've seen unemployment rates go up to the degree that they have, it has never happened that way, where there isn't another more nonlinear jump up. And I keep using that word. Is this time different that we're not going to see that? That's what people are grappling with.
We got to have some Bramo gloom the day before Thanksgiving.
There was some soothing gloom, though.
Soothing.
The deliveries changed.
I'm trying
the deliveries changed.
Less of a firebrand, you know?
Let's turn to the scores. Equity futures just about positive by 0.1% on the S&P 500. The bond market shaping up as follows. Muted moves. In one direction, sure, over the last 5 days, yields lower. But Lisa, they've been small moves. We're down by a couple of basis points on a 10-year.
Which I think is the important point. Is this the new normal? What we're watching, as you said, at 8:30 a.m. and at U.S. initial jobless claims, very important to see whether they inflect up further. 10 a.m. we get the second read, the final read on the University of Michigan sentiment survey. I'm watching the 5 to 10-year inflation expectations, which surged in the previous survey. And of course, we've been talking about all morning the conflict, the war between Israel and Hamas, and we have received news, which we all welcome, of the idea of hostages being released by Hamas, being returned to Israel as soon as Thursday, as soon as tomorrow morning. The question is, yes, this might lead to a ceasefire for 5 days, but after that, then what?
It's a rare positive development that I think we're all happy to see in the last day or so. With us around the table, I'm pleased to say, Jack Caffrey, Equity Portfolio Manager at JP Morgan Asset Management. Morning, Jack.
Good morning.
What do we need to see to get this rally to broaden out into next year?
Well, I think let's break this down into 3 steps, if you will. The holiday rally is certainly very much in force. As Tom just mentioned, November has been a really good year. I think against the context of what most people would have been putting forth as an idea of what to expect. With the end of, say, tech selling, with the return of the corporate bid, with earnings actually now being positive year on year, you have the ingredients of the next, call it month, 2, 3, of things being able to, I think, move a bit higher. Turning to what gets you a broader market rather than an extraordinarily narrow market, I think is I hate to say it, we stop kicking the can down the road in terms of what a continuing resolution turns into. How do we actually get some clarity on what federal spending might look like for a long enough time that we can then just worry about the election rather than how we're going to finance the election and our government. And then I do think you're going to have a continued tug of war between the earnings outlook and the multiple, where what happens in bond markets becomes really important.
It's interesting that the first thing that you pointed to was the political calendar in 2024. Is it that important for you?
Equity markets want to find something to worry about. And to the extent that most economics students chose to stay away from political science for a reason, we wanted to pretend we understood the math rather than understanding the psychology. And what we come back to, and where I actually have a degree, quote, formally in political economy. And at that point in time, I'm like, why? I'm like, well, I kind of think government writes the rules under which the economy operates. So it would help me to understand who's writing those rules and what they're going to set them up to be. So, paying for all of it kind of matters.
Jack, what do people do that have single-digit returns this year? You've been doing this for ages, and there's those certain years where we're all behind. How do you catch up?
I'm trying to figure that out because I'm behind this year.
Well, you got 3 minutes, so give us the answer. We want an answer now.
Oh, okay. Well, I should have bought a lot more NVIDIA. Would have been an important thing, but it doesn't really fit in a dividend growth mandate. I think ultimately it comes back to that question of broadening. A, and B, I think, if you look at a strategy, earnings were supposed to be down this year, they wound up being up. Dividends are up mid-single digits. You can find portfolios of stocks that have dividends that are up low double digits.
Do you fault big tech because they don't pay big dividends or establish double-digit dividend growth?
I don't think you can fault big tech for behaving in a way that they're rewarded. So to the extent that you can have companies that are valued on a price-to-sales basis, what everyone is telling you is we're not actually asking you to have earnings. So to the extent that you can have an entire, almost 30% of a market which doesn't have to manage itself from an earnings perspective to a consistent cash return to its investors, those management teams are going to do what they've done and continue to do that. I think dividends offer a real check on earnings and a real return of investors, and let them decide where to reinvest.
Lisa, NVIDIA drowning in debt, 1.1%.
Well, this is a cash flow just bonanza, right? And at what point are we pricing in a potential continuation of the pace of acceleration of that cash bonanza into the future? How do you even game out what we're pricing in, given some of the moonshots we've seen?
NVIDIA today reminds me a lot of Cisco in the late 90s as having been that defining stock that somehow sat in the middle to what Cisco was to the internet and the completely network world. Everyone hung on what John Chambers would say at 401, where he would shockingly manage to beat earnings time after time after time. And ultimately it came down to when his customers ran out of money to keep buying his servers. NVIDIA now sits in that particular position where they can sit there and look at the capital spending of Microsoft, of Amazon, of Alphabet, with some reworked chips, of what China intends to do in AI, what certain countries in the Middle East seem to be doing in order to actually build up their own AI equivalent. And you'll come back to at what point does the investments those other people are making start actually becoming more challenged? What's different now versus the 90s example, where I have to admit there's a difference, Cisco's customers were all debt financed. And so what the Fed wound up doing, draining liquidity, taking down the concerns and the flood of liquidity for Y2K, for people who remember ancient history, is very different than an extraordinarily powerful base of very profitable cash flow generating companies, which for the most part aren't being asked or pressed to return cash to their investors. In some cases, thanks to dual voting stock, that they're not ever going to be pressed.
This is a fascinating point. In other words, it's how long do the customers have open pocketbooks and plenty of cash, and their customers have big open pocketbooks and massive quantities of cash. So how much can you see the moonshot continuing in some of these names that we didn't appreciate perhaps at the beginning of the year?
Well, I think, Wall Street loves an easy story to understand. AI is conceptually really hard to understand, but if everyone wants to do it, everyone is going to keep spending. And certainly right now, the cost of capital is higher, but it's still not all that burdensome against a longer term history of what money should cost. To the extent that the companies which are really driving that spending either have access to a blank check if you're in China, effectively from state financing or personal financing, and ultimately coming through. But, you know, when you look through why are people somewhat disappointed in NVIDIA, I think this morning it's, oh, okay, that's all you've done for me. Like, what's double digit? What's effectively a 200% gain year on year?
Tripling revenue in a year or something. It's kind of nuts.
It kind of speaks to being a unique company in a unique place and time, but that comes back to, at some point, what have you done for me lately?
And that's where we are this morning. Lisa, I think investors also, they sort of gravitate towards stories they believe are divorced from the cycle because they don't want to talk about the cycle anymore. And this is one of those trends that you can just see out beyond a recession, a year, 2, 3, 4, 5 years down the road.
Well said. It also doesn't necessarily have the cyclical feel, since we're looking right now at something that is a moonshot in a very specific slice of history and has the dominant footprint.
Quickly, Jack, I'm calling the bull market the Ankampur Yardeni bull market, two fossils from the past like you and me. And the answer here is this a legit bull market, and are we at a 77 analog where this is the second leg of a bull market? You got a lot of scared people over at JP Morgan, don't you?
You've got some really enthusiastic people, you got some really scared people. That's the beauty of having...
Is it the second leg of a bull market?
You know, we've had a great year this month, and if we go back and look back 2 years, we're still down 2%. So, you know, we haven't really re-entered that bull market because we're still not back to highs. To really make the sustainable highs, you actually need more people playing along than what I call the sacred seven. Not the magnificent seven, because I'm trying to avoid theological belief in terms of growth rate. But I do come back to, you know, what we had was a good growth quarter. It seems like we got that because the inventory supply chain finally got fixed. Companies could actually fill the orders.
Right.
And right now the concern is, well, orders are seemingly drying up a little bit because you don't have to double order anymore because you actually get your stuff.
John, did you see this percent change on the Standard & Poor's 500?
Looking at it now. Year to date, we're up big time. Month to date, up something like 8%. Amazing. On the session at the moment, we're positive by 0.2%. Jack, you and I have had the privilege of talking together for a long, long time. I just wanted to squeeze in your call on housing, because you've had some interesting calls associated with that part of the economy. What's the call now?
You know, it's certainly the last several months, my bias has been we're living in the renovation nation. The idea that, you know, with an 8% mortgage rate, people are almost trapped. It's concept, trapped in your 30-year mortgage at 2 3/4%. The shame, the shame. But you're certainly going to see, I think, some freeing up of housing activity. I do think that comes back to, you know, will the bond traders finally be right and we start getting some rate cuts next year rather than this permanently high plateau that the Fed is talking about, which kind of reminds me of Irving Fisher about 1929, except now it's bonds, not stocks.
This was a clinic. Jack, thank you. Jack
Thank you so much.
Of JP Morgan Asset Management, and happy Thanksgiving.
Happy Thanksgiving.
From New York City this morning. Good morning.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
authorities.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
The war itself being over would require the eradication of Hamas as a threat to Israel. This operation right now requires that they remove more civilians who are under significant threat. So this war has weeks, if not months, to go forward.
That was the brilliant Norman Rule there, the former senior U.S. intelligence official. From New York City this morning, good morning. Equity futures pushing higher by 0.2% on the S&P. Just want to lock our attention on crude just for a moment. We've got WTI here down by 1.8%, $76 and about 40 cents. We're going into OPEC plus weekend, or at least we thought we were, Lisa. Talks scheduled for the weekend may be delayed, according to delegates. Have you got any idea as to why?
There was some talk about Saudi Arabia being dissatisfied with other members and oil production goals. I don't have any intelligence beyond that. That's what we're reporting here at Bloomberg in light of some of the potential delays. But here's the question. Do they need to cut more? And the idea that we're going to be talking about that, even with geopolitical risk, really highlights how much oil has been a missed call.
And I'm going to overlay on that the Bruce Kasman call of the next 6 months, 2024, being a 2.1% global GDP. I don't have the model in my head or on an Excel spreadsheet, but I'm suggesting that's oil south, or at least not up, would be sort of the guesstimate there.
You know, credit to the Saudis for cutting production when they did. Seriously. They were criticised at the time, but looking out to next year, we are all talking about decelerating growth. It was kind of the right move, wasn't it?
It was, and I think that they're feeling probably pretty justified, especially in light of some of the criticism. How much of this is decelerating growth and decelerating demand? How much is U.S. production, which is ramped up at a dramatic pace? And that's going to be really a key question that a lot of people are trying to understand also.
Or you could say they shaped the events they anticipated by pushing crude prices into the 90s. So, you know, pick your poison. But the latest so far from reporting suggesting that talks scheduled for the weekend may be delayed. This according to delegates, and crude at session lows off the back of that. Brent at about 80.76. WTI negative by, let's call it, Tom, 1.8%.
Very quickly here, John, do we get a lift in the markets here? Is this like the signal for the end of the year? I mean, we're in the holiday season. I think it's, I think we can all agree, even with the distractions we have of December 13th. But just, it's just like, I got money, what do I do?
What did Jack Caffrey say?
Yeah, I listened to every word.
What a year November's been.
Yeah. And
huge gains this month.
That's about it. You can see Jack Caffrey out on digital. We'll get that out to you as soon as we can. This is a joy, and away from the horror of the Eastern Mediterranean, to have Aaron David Miller with us is wonderful. He wrote a book in 2014, which ought to be reissued this morning. He's senior fellow at Carnegie Endowment for International Peace. And Aaron, with respect to our president, and to take your wonderful book here on the end of greatness, I want you to describe how you perceive any given president, but in this case, President Biden, with Mr. Netanyahu. How should we interact? How should our president lead, dare I say, Israel to a better future?
That's a very good question, and the president's been roundly criticized by just about everybody, with the exception of the Republican Party that has sort of emerged as the Israel can do no wrong party, for not restraining Israel, for not cracking down on the exponential rise in Palestinian deaths and the humanitarian catastrophe in Gaza. I'm Pithy, the Oracle at Delphi, reading the best of Godin Trails, can't tell you how this conflict is going to end. But I will say one thing is predictable, and that is Joe Biden's response to this crisis. For three reasons: his persona, the fact that the presidential model here is Bill Clinton, though a generation apart, both of these men have this preternatural love, I would say, I use the word intentionally, for Israel and high regard for its security. The president reacted to October 7 in a powerful speech on October 10th, which set the frame for his reaction. Second is politics. You have a deeply divided Democratic Party, progressives, and even mainstream Democrats, some of whom are calling for more restraint. But again, 2024, I don't think the president wants to leave himself vulnerable to Republican charges that he's weak on Israel. And the third P, persona, politics, is policy constraints. The fact is, Biden doesn't have any better answers to the three cruel dilemmas that the Israelis face. Number one, prosecute a war against Hamas and eradicate it in a densely populated urban area without endangering and killing large numbers of Palestinians. And then what do you do about the day after? I don't think the administration has better sense than the Israelis.
Aaron, you know, I look at the collective memory lost, and it may be as far back beyond 1948 or certainly 1967. We have a youth of America that seems removed from our collective memories of the Eastern Mediterranean. How do either political party corral the youth of America towards an understanding of America's effort in diplomacy in the Eastern Mediterranean?
I think it's virtually, given the generational divides, identity politics, the sort of asymmetry of power where the stronger party, regardless of its motivations or context, is perceived to be the Goliath and the smaller party perceived to be the David. I'm not sure that's possible. I mean, I would argue public service, but then again, I'm old and probably out of touch with this generation. You know, when it comes to foreign policy, I think George Will was right. For most Americans, and I think even for young Americans, they want as little of it as possible. So the fight, the struggle, the focus is here at home. And I worry about that young generation. I have two 40-year-old kids who I think are committed to trying to leave the world a better place. They are interested in foreign policy. My bias has become theirs to a degree. I think it's hard. It's really hard.
Lisa, I'm depressed when somebody young is 40. Okay, can I just let you know that?
But Aaron, I am curious how you see this evolving in terms of, we've been all talking about what some sort of humanitarian pause or ceasefire or whatever you want to call it, a cessation in fighting for 4 or 5 days to allow the hostages to go home to their families, to allow for humanitarian aid to enter Gaza. What does that lead to? Do we have a sense of what different camps want after that?
I think you broke the code. I think that's the key question, is what we're witnessing within the next 24 hours when 50 Israeli women and children will be released, hopefully 3 Americans, including a 3-year-old that's about to celebrate birthday. Is this a headline or is this a trend line? Hamas took prisoners for 2 reasons. Number one, to trade them for asymmetrical number of Palestinians released from Israeli jails, 150 in this trade, because this resonates deeply in the Palestinian street. Hamas also took hostages in order to constrain and delay an Israeli ground campaign. The hope is that pressure will mount, a 4-day pause will turn into a 6, 7, 8, 10-day pause. Pressure will mount for what Hamas really wants, which is an extended and prolonged ceasefire. That is going to be extremely problematic for an Israeli government that seems to have no intention of stopping its military campaign. But pressure is going to rise, and we have 2 clocks ticking. The Israeli operational clock, which is ticking much slower, weeks, perhaps months. Biden and the international community's political clock, which is ticking much faster under the pressure of the humanitarian catastrophe in Gaza and the exponential rise in Palestinian deaths. It seems to me this situation is going to get worse before it gets much worse, I'm afraid.
Back-to-back clinics on this program in the last 30 minutes. Aaron David Miller there of the Carnegie Endowment for International Peace, just phenomenal. Some of these conversations, Lisa, just need to get home and go back over. State of play, Hamas has agreed to free 50 hostages from Gaza in return for a 4-day ceasefire with Israel and the release of 150 Palestinian prisoners. What you just heard there, though, is that could be the starting point for a bigger push to get a much longer ceasefire as the pressure begins to build, continues to build, I think most people would argue, on the Israeli government.
And what Aaron David Miller said there about 2 different timetables, the Israeli government having perhaps weeks and months, and what we hear from President Biden in a very different political calculus, it's a shorter calendar, highlights the tension that must be underpinning some of these discussions.
And I would go to Robert Hormats yesterday, both Aaron David Miller and Ambassador Hormats saying, look, we got to look in the mirror at the state at home. For Hormats, he's written about this for at least 3 decades, if not 4. It's about the state of the federal budget and, you know, the debt and deficit here. How do you prosecute diplomacy and defense if you're distracted by a debt and deficit?
Just to extend the analogy just a little bit more, it's not just that the clock is ticking. I think for the president, the alarm went off over the weekend. given that poll we saw out of NBC News.
Stunning poll.
Yeah. Equities right now on the S&P positive by 0.2%. Coming up next, Earl Davis of BMO Global Asset Management on fixed income. For once, so far, got no idea if it changes. It's a bit of a snooze in the bond market.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Jack Caffrey, JP Morgan, with the line of the morning so far, and good morning to you. What a year November has been for this equity market. The Nasdaq 100 up by 10.6%, best month since January of this year. The S&P 500 month to date is up 8%, best month since July 2022. We had some weight to it this morning, up by 0.2% on the S&P. On the Nasdaq, up by 0.4%. Even a small caps participating, Tom, up by 0.5%.
Moments ago, the VIX pricing at 12.99. You can price it now, John, at 12.98. This is coming down. That's a bull market VIX. For history here, John, rarely we get to a 10 level on VIX. And trust me, 12.98, we're almost there. I mean, we're
Sure.
on the edge of nirvana.
We've joked all year that equity investors are trying to make bond market calls. I don't think they want to try and make bond market calls. They just don't want to look at the bond market. And the good news is that over the last 5 days, you can kind of ignore it. Treasuries right now, 2-year, 10-year, 30-year. Let's sit on a 10-year. And I'll go through the intraday moves over the last few days, Monday through Wednesday. Monday down a basis point. Tuesday down 2 or 3 basis points. This morning down 2. Finally, for now, I know for now it could change. But Lisa, have we got some stability in treasuries?
It seems like it. Can you bank on it? I don't know. Lori Calvasino, we've been mentioning her outlook all morning, but she said that the greater appeal of bonds, just because of the higher yields, may end up being a dampener of U.S. equity market returns, but not necessarily a derailer of them. And it seems like bonds might be a dampener of some of the appetite for risk assets, but not a deal killer. And that seems to be the case unless things get out of control. And that's the reason why volatility
Are we
matters.
out of control with West Texas 75? We're going to get a 79 handle on Brent at any moment. I mean, the disinflationary tendency of hydrocarbons here is tangible.
We'll get to crude in a second. I just want to round it up on what's happening in treasuries. A month ago, so it is November 22nd, and your 10-year is 4.37. On October 23rd, your 10-year was 5.0187%.
Yeah.
That was the height of the cycle. So it's been a big turnaround in the last month, a move of something like 70 basis points or so. That's the story of bonds. Tom wants to talk about hydrocarbons. Let's talk about crude. Session lows, down on WTI, down on Brent by almost 3% now. This off the back of a headline that talks scheduled for the weekend might be delayed, according to delegates.
So we'll be able to go to Vienna.
I think Manis is going to Vienna for us.
Really? Is he? Good.
Yeah, Manis is going to do some
Manis
okay
Graham.
coverage for
Team
us
coverage.
out of Vienna. Lisa, the crude market's reading it one way. I have to say, sitting here, I've got no idea how to read this, but certainly crude is down by something like 3%.
Maybe the idea here is that there are certain delegates that don't want to cut production. I'm not sure exactly what the rationale here is, but how much have we gotten this wrong? How much do we not understand the move in terms of, is this demand going down, or is this production in the U.S. offsetting some of the cuts that we saw from Saudi
Or is
Arabia?
it the memory of 1986 where OPEC was simply OBE, overcome by events? And I don't know what to do with the JP Morgan global economy of 2.1%. I don't know what to do with that. That's an original statistic.
We'll return to that, Tom. I want to get you some top stories. Under surveillance this morning, Hamas agreeing to free 50 hostages from Gaza in return for a 4-day ceasefire with Israel. Israel will release 150 women and Palestinian prisoners under the age of 19. Israeli Prime Minister Benjamin Netanyahu vowing the war will continue after the ceasefire and Hamas will be destroyed. Your next story, Sam Altman returning as CEO of OpenAI just days after his surprise firing. That's the story that we've seen dominate the news flow over the last week. The company also naming a new board of directors, which will likely include representation from Microsoft, the company's largest backer. The maker of ChatGPT facing immense pressure to rehire Altman after nearly the entire staff threatening to resign. Microsoft CEO Satya Nadella endorsing the move after offering to hire Altman for a new in-house venture. Microsoft, Lisa, up by about 1%. I think we've all said it. Satya Nadella, more than unimpressed over the last week.
I love that in his interview with Emily Chang of Bloomberg, he was so controlled, and he was very much just seeming to be, displeased with the fact that they were not informed before this move was made, but they were reviewing the situation. I wonder if he was incredibly animated in some of these calls, and if he's gotten on the phone with other board members and saying, can you tell me what in God's name happened that this happened? I mean, because he doesn't even know.
But the summary here into Thanksgiving and to stagger to Monday is all in all, this is a win for Microsoft. I mean, it's up a stick now, I get it, but...
Mandeep Singh's really pushed back against that.
Yeah.
And I know we're all...
I don't know, I'm asking.
We all celebrate the success of Satya Nadella, but I want to go back to something Mandeep said. To take an investment in a company this large, to own 49% of it, Tom, to have that 49%
And not know what's
stake,
going on?
and not know what's going on and not have a seat on the board, is a misstep from Microsoft. We can talk about some of the brilliant things they've done, how nimble Nadella has been over the last week, how he's managed the situation with grace, but that was a rare misstep from Microsoft, which really materialized in the wrong way for them.
The coming days on that will be interesting. Is it over? Can we move on from
I've got no idea. We're going to get some
OpenAI,
grand story about what they think happened, and I hope we move.
More OpenAI.
I hope we can talk about things like Nvidia a little bit more, turning positive in pre-market trading after an earnings report which blew past Wall Street expectations. We've talked about that a million times this year. We can do it all over again this morning. The world's most valuable chip maker forecasting revenue of $20 billion in the upcoming quarter, with the average estimate sitting at just under 18. Despite the upbeat report, Nvidia expecting new export rules to China will cut into its income by this time next year. The stock turning positive. Lisa, I keep returning to that quote from Gillian Emmanuel over at Evercore. Where is it? In the near term, great isn't always good. And I read that going into the report, and then I watched this drop yesterday, saw the stock price reaction, and just thought, Julian, nailed it.
This is an overachieving child. And basically, everyone is trying to figure out, what more can you do for me? And basically, they came out and they said, look, this is really good. And everyone's thinking, yeah, you could do better. And that's
Were you an
essentially where we're at.
overachieving child? This feels personal. Is that what happened to Bramo?
No, but I'm really not.
College degree in 2.5 years.
Let me just tell you.
What else have you got? Post-grad.
Let me just tell you, I am not an overachieving chef, so let's just set the bar there. We can discuss that.
We're lowering the bar going into Thanksgiving at Casa Bramo. That's what just happened.
Oh, the bar just is on the floor. We're going to order it afterwards.
Restaurant is the way to go. It just
You've
solves
said that a few
everything.
times, yeah.
You know, it's
Why not?
I have huge respect for both of you in getting through this. This is a really important conversation right now. It was important 30 days ago, but it is important into 2025. Earl Davis has had a fixed income, BMO Global Asset Management, and I can't say enough about the controversy of his call that Jerome Powell will stay the moment and keep rates higher for longer. Earl, do you stick with that call?
100%. And that's one of the things we're looking at in the market now in regards to how many eases are being discounted for next year. We see, we're on our way to 100 basis points of eases by the end of next year, which we think that, I always believe the market, but in regards to the pricing at the moment, but it's our belief that they'll be firmly on hold next year.
You're out of Western Ontario, the land of perfect statistics. What's the correlation of your Fed call, your higher for longer call to the equity markets?
Oh, that's a great question. The higher for longer doesn't matter to the equity markets. Their discount rate's the long-term rate, right? The 10 to 30-year real rate. So what happens on overnight won't impact equities unless they do ease. Then it's just a euphoric buying of equities. But from a quantitative perspective, it's the 10 to 30-year real rate that matters for equities.
When we talk about the 10 to 30-year rate, we were talking yesterday with Michael Collins of PGIM Fixed Income. He said he could see a material further decline in real yields just based on the fact that people are expecting this growth to continue and that he thinks we're seeing the signs of a more material slowdown. Do you agree?
I agree eventually. I think the real rate will stay elevated for a while as long as the economy remains resilient. I know we're getting mixed numbers, but the economy overall is still doing well. Less and less calls for a recession during 2024. As long as we have that, real rates will stay high because that's the counterbalance to the economy doing well. You need to take money out of the growth economy into the savings economy, which is real rates. And to fight inflation, which, it seems like people have forgotten, part of fighting that is keeping the real rate high.
So in other words, you're saying you don't think that the slowdown that we're seeing on the margins is enough to bring inflation lower, and that currently the 0.9 percentage point decline in benchmark rates, the cuts that people are pricing into the market next year, are overstated.
So I'll say two things. It's not necessarily the slowdown that we're seeing, it's the pace of the slowdown. Is growth declining fast enough? There's still a lot of excess demand in the economy. I see it when I still go to the stores and restaurants. Yes, it may be savings, it may be credit that we're seeing at retail sales, but people are still buying. That is excess demand. That's a big driver of the growth in our economy, and that's what leads to inflation. So I don't see it on that part. On the inflation front, we're getting constructive numbers, but we are still very worried about wage inflation and that pass through into pricing.
It's right where I wanted to go. You really center out wage inflation. How 60s are we? I mean, the idea of, forget about cost push, demand pull, and the rest of it. Is it just plain and simple wage inflation that we remember 40, 50 years ago?
I think we're getting there. The difference between now and the 60s or 40s and 50s years ago is the amount of unionized employees. It's significantly lower now than it was before, but that trend is increasing. And what happens when that trend increases, and we're seeing the wage increases, UAW, UPS, you look abroad in Canada as well, what happens is the people who are non-unionized have to get wage increases. And we saw that with Honda and Toyota. So we're not quite 60s, 70s because we're not as unionized, but that trend is increasing, and the wages will remain a pressure
on inflation, I think it leads to secular higher inflation, 3-4% instead of 2-3%.
So what's your highest conviction, Earls, heading into next year at a time where people seem to be moving in the opposite direction, celebrating soft landing, celebrating maybe the return to the old normal? Where's your conviction lie?
The highest conviction is that there's no eases until at least Q4. So that means just by shorting 2-year bonds or any part of the curve, you make money if nothing happens, because the overnight rate's still 5.25, and we saw where 10-year bonds are right now, right? So that's negative carry trade to own those versus overnight. So highest conviction trade is no eases, Fed on hold till at least after the election.
Wow, Fed on hold until after the election. Oh, that runs counter to a lot of people. What do clients say when you tell them that?
Well, first I tell them following a winner is a loser's game, So if we try to follow what the crowd's doing, we're always coming in second. So we base our views on tailwinds, on fundamentals, on quantitative numbers. And that's what has proven to be successful in the past. We just show our results and we say, what's our markers? So for example, where would we advance our eases? Where do we start believing what the market's saying? For us, the key number to look at is unemployment rate above 4%. As soon as it gets above, then, I think the safety's off, so to speak, in regards to eases. We're not even closer. We're at 3.7 still, so we still have a ways to go. And I think the Fed would like to see it closer to 4.5 before they start easing. So that's our trigger, and that's what we tell clients what we're looking at and what will help us change. And they know our results, and they know this is the most volatile year in fixed income, and we're outperforming in it.
It's nice to get an original thought, Earl. We appreciate it. Earl Davis there of BMO Global Asset Management. No cuts until after the election. That's quite cool. If you're just joining us, welcome to the program. Equities on the S&P 500 shaping up as follows. We're positive by 0.2%. Yields are coming in about 3 basis points, 436. Lisa, I don't know what you think about that. No rate cuts until after the election.
That is so counter to the expectations right now. Just to give you a sense, people are pricing in almost a full percentage point of cuts by next year, by the end of next year. He's saying they're not going to do it because they don't see the weakness, they don't have the conviction. The political aspect of this is one of the most unspoken aspects. How do they justify a cut that could be perceived as something that could help the incumbent versus not? How do they remain that independent?
Does it save the banks? I find that fascinating. If you get an Earl Davis call, total outlier call.
Do they want cuts or hikes?
With great respect to his track record. I'm not sure what the banks want, other than they'd like 2023 to end.
He said line of the sand was 4% unemployment, and maybe the Fed wants 4.5. I think we're about 3.9 at the moment, Bramo. So this goes back to the labour market.
Exactly.
Yes. Again, which is why we're looking at claims at 8:30 Eastern time.
Which is why everyone should be watching on the day before Thanksgiving, is for claims that really will give us a sense of the trajectory going forward and whether that call is
I'm going to take it so seriously, I'm going to leave the set and go back to my Bloomberg at my desk and watch claims come in. That's what I'm going to do.
You're going back to start cooking. Or, you got
I need to start cooking a little bit later, yeah.
Somebody emailed me in on creamed onions. Martha's got creamed onions down
Creamed onions, okay.
Yeah, it was
Next up on this program, this is the only reason I'm here today is the following segment, the next one. We're going to catch up with Madison Miller on the potential impact of Ozempic on Thanksgiving. That's all I'm here for. It's my favourite topic.
That's a shot, right? It's not pills. It's a shot.
Get some shots, TK.
Yeah.
People are microdosing Ozempic. You hear about that?
Oh my God, really?
Microdosing Ozempic. Someone told me about that. Yeah.
Wow, that's new.
Little shots.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It underlines that for the first time, we really have an efficacious way to address weight. And many patients have been trying to lose weight in all kinds of different ways, have not succeeded.
The blockbuster drug of 2023, that was the CEO of Novo Nordisk, the company behind Ozempic, speaking to Bloomberg earlier this month about the increasing popularity of appetite-suppressing drugs, prescriptions skyrocketing 300% from 2020 to 2022, food manufacturers and retailers preparing for the potential impact as we enter the holiday season. TK, this stock up in Europe by something like 49% year to date and knocking LVMH off his perch for market cap in the continent over
Europe,
the last few months. Yes, just
so
amazing.
It's got like FDA approval, obviously. Somebody must have approved it. It's a shot. So like, it's got, where are the competitors? I mean, if this is that successful, NVIDIA is like a 6-year plan to make a chip. Come on, you put the chemical, they all copy the chemicals,
Novo's
right?
in the mix, Lilly's in the mix, Bramo, there's a few in the mix.
Yeah, there are a couple of them. The real distinction here, and to the point of how much of an impact this is going to have in the broader food and drink industry, is how are people taking this? Are they taking this medically in order to reduce the obesity epidemic, or are people doing this recreationally to try to achieve a look? No, I mean, I'm serious. This is actually a serious concern.
I think the answer is both.
Right.
Yeah.
So then, at what point is it sustainable given some of the side effects?
Sure.
And at what point is it medical? And are we conflating the two in a way that sort of exaggerates the effort, or are we underestimating the desire in our society for
I've been
a physical
really
aspect?
unhappy with the coverage because I just don't think we're looking at it as a medical story. We're looking at it as a money story, shits and giggles stories, if you will. People like me make jokes about it. No, well, Anne-Marie was here. She trained me. But the answer is that really importantly here, are we talking about this as a medical story?
Oh, Tom, it's a money story because it is a medical story. And such a large slice of GDP in this country is healthcare. We're talking about this country, Tom, pushing 40% obese. 40% of the population, more than a third, obese. That's what we're talking about here. And if you don't think that's a money conversation, then I think you're on another planet. Of course it's a money conversation.
I get the obesity story of America, but as Lisa mentioned, what are the side effects here?
Well, that we need to get into without a doubt. On the branding, what I think is interesting here is that we're all talking about Ozempic. We don't even really know the names of the other drugs. It's kind of like search engines. We talk about Google. You don't talk about Bing and Yahoo search, do you? But this is it now. As Novo already won, just by the very nature of the conversations we're having about these food suppressant drugs. We just call them University Ozempic.
Right, exactly.
We're going to inform you now after 3,000 calories tomorrow. Joining us, and she's cut and chiseled out of the Ryan Fieldhouse at Northwestern. Madison Muller joins us right now, where everybody at Northwestern is all, nobody's taking Ozempic at Northwestern. Madison, there's a lot of jokes, including from clowns like me. Get serious here. What's the downside to Ozempic?
Yeah. I mean, as you guys were just discussing, it's really important medically speaking, and that this country does have a huge problem with obesity, and obesity affects over 200 other chronic conditions and different conditions. And so the impact on health and healthcare and just prevention of disease is enormous. But there are downsides. I mean, people have side effects like nausea, vomiting, different stomach problems, varying degrees of severity. And that's something that the drug makers are really focused on working out right now in this next generation of drugs, is figuring out how to make weight loss drugs with fewer side effects, because for some people it is a deterrent from using them.
Madison, some of these drugs are aimed at diabetes, some aimed specifically at weight loss. They contain both the same active ingredient. Is that just marketing or different amounts of that active ingredient? What is that?
Yeah, so in Novo Nordisk's case, so Ozempic is the drug for diabetes, and Wegovy is the drug for obesity, and they are different dose strengths. Wegovy, the obesity drug, is a higher dose, it's stronger. And for Eli Lilly's drugs, we have Mounjaro and Zepbound, which was just approved earlier this month. And in that case, those drugs are the exact same dose, exact same active ingredient, virtually no differences between them besides the marketing. And it is for sort of commercial purposes in that case.
Do we have a sense, Madison, of how many people are taking the drug, of how widely spread this is expected to be in terms of dissemination, and whether people are taking it more for medical reasons or more for just pure weight reasons?
That's a good question. I mean, I think that that's something that we are still trying to figure out right now in terms of off-label usage and how much that's happening. I mean, there are a lot of people are using these drugs who do have obesity and who do have diabetes, and they're seeing incredible benefits from it. That's, undeniable that these drugs are totally life-changing for people who need them. And there are also people that are using them off-label more, but the drugs are exorbitantly expensive. So the costs sort of prohibit widespread usage right now, unless you are able to get the drugs covered by insurance, which is sort of spotty. It's not really, there's not widespread insurance coverage. Medicare still doesn't cover weight loss drugs. So it's an interesting scenario right now, but we are seeing projections that this market is expected to grow to 100 billion by 2030, and that's, only a few years off. So it's growing rapidly, and there's a huge addressable market here.
How much of a push is there to get insurance to cover this? And how much does that really factor into the pricing, considering the fact that ostensibly we're trying to parse the difference between obesity and medical issues like diabetes, but there's a lot of associated side effects to also being overweight. So there's a question here about what the distinction really is and whether some of the other costs start to go down as well that would prompt insurance to really be forced to take this up.
Yeah, that is the conversation that is playing out right now. Insurance companies are still, in a lot of cases, unwilling to cover these drugs because those real cost estimates haven't come out yet. And that's something that the Congressional Budget Office is actually looking at right now. And they're asking for more research, more data on the prevention and how much money the country will save actually in using these drugs and preventing future disease. Because, like you said, there are so many other related conditions. And just a couple weeks ago, earlier this month, we saw at the American Heart Association conference in Philadelphia, Novo Nordisk presented data showing that Wegovy cut the risk of heart attacks and strokes by 20%. And that's huge. And so we're seeing already these studies, and there are other studies coming out about sleep apnea and knee osteoarthritis and NASH and different related conditions, chronic kidney disease, to see what the real impact is and what other conditions we might be able to ward off by using these drugs in people with diabetes and obesity.
Forgive my reaction to that, Madison, but every time I see those headlines from those studies, I kind of sit there and I'm like, well, yeah, duh. Like, didn't we know that already? Madison, what is revealing about any of that?
I mean, some of it is to be expected, that when you reduce weight, when you control blood sugar better, it will have these sort of knock-on health benefits. That's to be expected. But there's also something going on, that we've talked about, that there might be this added extra benefit. There might be something going on with the drugs themselves, that they're having a positive impact on the heart. Because in these studies, we saw basically from day one that there was an improvement in heart benefits with people that were taking the drugs, sort of regardless of how much weight they had lost. These benefits were seen from the get. So there's something else going on, and that still remains to be seen what exactly that is. But there's these incredible benefits that we're seeing just beyond weight loss. And it's also showing that obesity is a real disease. It's not a lifestyle condition that is, can be controlled just by what someone's eating. It's a real medical issue.
Madison, thank you. Fantastic contribution. Madison Muller there of Bloomberg on what's happened with some of these blockbuster drugs this year. Lilly, that stock is up by something like 62%. Novo Nordisk up by something close to 50%. That issue, Tom, heart disease, the #1 killer in this country.
There's no question.
Heart disease.
No question about that. I'm also looking at the literature out on the web, which is this is $900 a month. And what happens when you stop taking it? So is it basically a $900 a month? What is that? $9,000 a year? Plug into the math. It's Wednesday, but $9,000 a year, and you're in it for life.
Well, there are a lot of questions around the longer term and the short term side effects, and this is something that people are going to be studying. The bottom line is the fact that weight loss drugs are currently being thought of and experienced in such a concrete way has changed the conversation in the same way that artificial intelligence did in the tech world. And that, I think, is going to be a game changer.
Well said, Bramo.
Thank you.
I couldn't agree more.
She's like on her game today. You and I are slacking off.
A pillar of this economy is obesity. So much of this economy is leveraged to that tragic issue in America. That's the story. Alberto Gallo of Andromeda Capital Management joining us shortly from New York. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Of whether we're seeing more consumer weakness, we could very well be.
The economy will likely slow down from where we've been, which is a strong point.
We are holding on to that slowdown, but we've been surprised to the upside throughout this year.
We are making progress in terms of taming inflation, bringing inflation off of those peak levels.
Really, I think we're going to be looking at modest growth next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Bramwitz, and Tom Keene on radio, on television. Lots going on this morning, many different narratives as we prepare for the holiday season. In this hour, the interview of the day, Helene Becker, on how bad it will be, John.
Yes, what you're focused on, isn't it?
I'm focused on Helene Becker. What's the travel going to look like? Rain here in New York, that being away, I'm told, but you wonder what trains, planes, cars.
Sure.
Helene Becker on the airline industry.
Tom, absolutely obsessed with the airports he won't be going to in the next 24 hours. You're not even traveling, but it's very good of you to be concerned about everyone else.
Somebody said it's going to be the worst in 50 years, and what's important is every plane you're traveling on has an NVIDIA chip.
We're getting back to travel, and I think that's the best news. You know, seriously, it's
post-pandemic,
great.
just
move on.
Yeah.
Move on. That's fantastic to see. One of the worst performing stocks of the year. And this is not a commentary on the stock, just a commentary on the broader takeaway from seeing that stock where it is. Moderna. We're all moving on. That's much
We're moving on from this, and of course it is a consumption. And preparing for Thanksgiving is getting the Abramowitz turkey in the new refrigerator. I mean, it's going to be a welcome kitchen this year.
Oh yeah, it's fantastic, and it's bigger, so I can really stuff more things in there.
When you plugged it into, the lights dim in the rest of the house.
Yeah, we had to generate some new ideas. But let me just put this way. I bought something big, and a lot of other people are buying things that are big, whether it's turkeys or whether it's
the
just
consumption,
general.
which has been the surprise of the year.
And that's really where I'm focused.
I thought we got warning after warning about big ticket items.
It's true. I tried to move against the grain.
Tried to contribute.
Exactly, which is good. But, you know, there are other things that are going off the shelves.
But that folds into our narrative this morning. And, you know, Alberto Gallo coming up, particularly on the bond and European view. John, I got equities up. I got bonds in. I got oil on the edge of a crater, and I'm sorry, it's world, it's U.S., it's everybody at Bramo's house demand.
It's Bramo's world, TK, that's for sure. You said Helene Becker was the interview of the hour, data point of the hour's jobless claims, 8:30 Eastern time in about 28 minutes, without a doubt. And we're looking for claims to come down to 227 from 231.
It's got to break.
It's just started to climb just a little bit.
It's got to break to get to this soft landing baloney, and we're not there yet.
And we heard from BMO an hour ago, 20 minutes ago or so, talking up the prospect of no rate cuts whatsoever until you get through 4% on unemployment and something closer to 4.5. I wonder what that would do to this equity market, Tom. And I'll go back to something I said a little bit earlier this morning. We've said it on this program before. If this labour market's no longer a reason for this Fed to be hawkish, when does it become a reason for this equity market to be bearish? And Tom, how close are we to that moment?
I don't know, but we're breaking down again. I'm waiting for the 30-year intraday chart to come up on the 2-year. You can do this on the Bloomberg Professional Service. John, the 2-year yield breaking down near that 4.80 level. We're not there yet, but we're moving in a direction here which gets you away from all the gloom of high rates.
We broke 440 on a 10-year. In the last 24 hours, we're down another 2 basis points to 437. Single-digit moves, low single-digit moves through this week. Monday, Tuesday, Wednesday. We've had 5 days of yields moving lower, including last Thursday and Friday. Your 10-year, 437. Jack Caffrey at JP Morgan. The line of the day, the line of the week, the line of the month. What a year November's been. The S&P 500 up by more than 8% this month. TK, the NASDAQ, up by 10.6%. in November.
Huge moves, and the NASDAQ up 0.4% right now. This morning we had a VIX of 12.XX98, I think is what we got to. 13.02%. We got a lot for you, seriously, in this hour. And in the 9 o'clock hour, John Farrow, turkey leftovers, what to do Friday. Look for that.
Wait a second. We call it my show. My show at 9 is now turkey leftovers.
It's a D segment. It's like the exit segment.
We're calling my hour on TV turkey leftovers.
Yeah, you stand there with a little chef thing out of the hat. You stand there with
I'm leaving this show early. I'm gone in like 5 minutes.
It'll be turkey leftovers. He's never had a turkey. Alberto Gallo joins us now.
Oh, boy.
Yes, with his service to the government of Italy and, of course, his work here with Andromeda Capital Management. What a raging debate, Alberto, on where yields go the first half of next year. What's the Andromeda bet?
Good morning. So as you were saying, there's a lot of happiness, a lot of complacency in the market. And we're again in a situation where we're pricing a lot of cuts from the Fed and the European Central Bank, but without a hit to growth. So we're pricing Goldilocks. We're pricing low inflation, central banks cutting, but without so much recession risk priced into the stock market. And this is also because this year we had a lot of shorts in the market. There's still people that are short, that are underweight risk assets, and it can continue. But we think that rates, can go up again. We think inflation is persistent, and governments will have to issue a lot of debt because fiscal spending continues. And you've seen the UK tax cuts, for example, coming today. So fiscal spending continues in the US, in the UK, in the Eurozone. So we're not done here with the call on duration. We're not done. We think we're going back towards where we were previously this year. Maybe not 5%, but we're going back up.
We are done over at OPEC Plus. Just to get everyone up to speed on the latest news, there was a suggestion in the last hour that maybe OPEC Plus would be delayed. That meeting would be delayed. We're now hearing from delegates. The meeting scheduled for the weekend has been delayed, Tom, delayed until next week.
Well, that's because they can't agree. I mean, they're getting out front of like...
TK. Yeah, it looks that way.
There's a why to this.
That's the latest then. The meeting has been delayed until next week.
79.45 on
delegates. We're
under
breaking
80,
down?
Under 80.
Breaking down on crude in the last hour or so. Alberto, you've got to put money to work. Given what you just said about the Federal Reserve, what have you been doing in the last month as this equity market has continued to rip?
But definitely, moments of geopolitical risk, moments of fear in markets, like what we had in March earlier this year with SVB and Credit Suisse, or what we had in October, can be moments that provide opportunity for tactical investors. So we put a lot of money to work in October, and we put a lot of money to work the whole year, but particularly in these moments, you have these locations that can be pretty useful. And the markets are rallying. There's more room to run for credit. It's an environment where equities, are expensive, and wages are growing, corporate profits are okay, but everything is priced in. You've seen Nvidia yesterday. It surprises to the upside in terms of earnings, but stocks can't reprice more than they already have. So credit is offering today yields that are double digits, and that's in the high yield market for companies that are relatively large, and sometimes they also have shareholder support or government support. So these are high quality trades for us when we have good margin of safety, and we're looking at new issues in corporates, in banks, in defensive sectors, in sectors that are resilient with high interest rates to pay us that kind of yield, double-digit yield, which is a pretty juicy premium over treasuries, and that's pretty attractive to us today.
Today. That was a really interesting note that it was today. There is a question and a tension underpinning this complacency that you talk about with pricing in Goldilocks and then leaning into what's been working. When do you push back against the sentiment that has been the driver and the winning driver year to date of returns?
Lisa, this is a great question because obviously, we do think that stock markets are a little expensive and rates markets are pricing too many cuts. But going into Thanksgiving, going into the holidays, and with a short positioning in the market, especially in rates, it's sometimes hard to take the other side. But we do think that in Q1 next year, issuance supply will come back. Governments will need to issue. Now, this year there was a lot of retail component that helped governments to fund, even up to 10% of the issuance as retail investors, went into treasuries or into Eurozone government bonds. And next year, what's happening is banks are more competitive. Finally, banks are increasing deposit rates, so governments will have to compete with banks for retail funding. And I think that bond yields in the 5 to 10 year part of the curve might go up again on simply on issuance and fiscal spending. And we don't think there's a recession coming next year. It's just a gradual slowdown, which means that probably the Fed doesn't need to cut. The ECB doesn't need to cut, at least for the first part of the year. So there's a lot of positive expectations there that could disappoint a little, and then we'll see volatility again.
So what's the bigger pain trade right now, at least heading into Q1 of next year? Is it economic resilience or is it economic pain?
The pain trade is there's still a lot of shorts in the market. In credit, we see shorts in the CDS indices. There's underweights in equities. So the pain trade is for risk assets to keep grinding into January. And we're seeing it playing now. There's essentially investors were very hedged, and these hedges are coming off into the year end. But next year, we probably will start with a more lean positioning, with less shorts. So, the market will have a higher hurdle in going up, face a higher hurdle. So we are seeing a giant short squeeze, but there's a lot of positive expectations priced in. So we have to be tactical here.
The bar gets higher going into 2024. Alberto, happy Thanksgiving, sir, to you and the team. It's great to catch up. Alberto Gala there of Andromeda Capital Management. The team here at Bloomberg working hard on this OPEC Plus story. Grant Smith leading our reporting, so allow me to share some of that reporting with you. The OPEC Plus meeting is scheduled for this weekend, has been delayed. Talks, we're told, running into trouble amid Saudi dissatisfaction with other members on oil production levels. Lisa, the meeting will now take place next week, according to delegates. Saudi Arabia, which of course has been making these additional cuts going back to July, in difficult talks with other members about their production levels, according to delegates.
So I don't really know exactly which way to take this. The market's clearly taking this as maybe people are reluctant to cut as much as Saudi Arabia would like, which is maybe the reason why prices are falling. I don't know what to make of it, except that this definitely highlights that there is a lack of consensus in the same kind of way of what's required, and then also whether to cash in on what you can get out of the ground now, or whether to try to work together with the collaboration of OPEC Plus.
Or the underperformance of energy, and I find it fascinating. Brent crude down 35%, the drawdown down 35%, ExxonMobil down 13-ish%, something like that. And even Aramco, John, directly related to OPEC, Aramco down only 10%. I mean, is it just oil hasn't dropped that much, and oil stocks haven't dropped that much and have more to go? The mispricing between oil equities and oil itself is a study alone.
We're down something like 20% from September, which is kind of nuts given what's developed in the Middle East in the last 6 weeks or so. If you just joined the program, the scores look like this. I'll start with equities and we'll shift over to the commodity market. Equities down by 0.2%. Crude, negative 4%, 74. Wow. 67. Brent crude, Tom, you nailed it. Break of 80 to the downside, 79.35.
To 80, and I don't know how much academic visibility or market economics visibility there is beneath. I can't believe I'm saying this, but the 69 print. I mean, I don't know where we are there, because there was such a skew towards greater global demand, 90, 100, dare I say 110, and to borrow from the economist Walt Disney, it's a whole world after all.
Well, I want to understand better why, right? Is this demand? We're talking about how everyone's going to be traveling. It's expected to be a new record in terms of traveling post-2019, going out before the pandemic. So where is the lack of demand coming from, right? Is this just an issue of China, or is this just simply supplies that the U.S. is suddenly producing in a much more significant way?
Yeah, Jared Saravello's publishing for Deutsche Bank in the last hour, and he, the wonderful summary note into the end of the year, and he makes clear how lumpy it is. The U.S., I'm not sure there's a collapse in demand, at least yet. Rest of the world, there's some real challenges out there.
I'm just going to get to my teas, if we can just get a little bit of time for my teas.
Squeeze it in.
Coming up on
tear up?
turkey leftovers, otherwise known as the Open, to people who care about it. Tom, Larry Adam, Raymond James, Torsten Slock, Apollo, Amy Wu Silverman of RBC. I'm leaving. Happy Thanksgiving from New York.
What are they going to do with turkey?
Dark
Good morning.
Why me? What do you do?
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you
You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
To the question of whether we're seeing more consumer weakness, we could very well be, and we should expect to see some weakening go on there after this period of strength with the high inflation, with the drawdown of savings.
Joanne Feeney, Advisors Capital Management, there yesterday, giving us a view on the equity market. Lots going on here on Wednesday. We welcome all of you on the edge of travel. Helene Becker to be with us in a moment. Lisa Bramwitz and Tom Keene. Without question, in 14 minutes, jobless claims is clearly front and center. And then to go out about an hour and 30 minutes, Turkey the Friday after with John Farrow. I'm really looking forward to seeing what he does with the dark man.
Oh, yeah, I'm sure that he's going to really enjoy that. I think he's going to take a break. But honestly, I just do think that this Thanksgiving, the fact that people are traveling to go back to their families is a good and beautiful thing, honestly, especially after the pandemic.
Yeah, we'll have to see what the parade is tomorrow. Macy's parade here in New York City.
Have you ever
Weather
gone?
clearing. Oh, many times. Oh, yeah. There's a point where they used to come by the window. But the bottom line is the rain here today, the airplane delays tangible. So maybe tomorrow it'll be clearer and better for the parade. Would be the idea. Let's do a data check. An equity lift. If you're not in the market, good morning. Futures up 10, Dow futures up 28. The VIX had a 12 handle. A bull market 13.05. Bramwell, help me with bonds. I'm looking at a 2-year yield, 4.85%. We're not at new lows. It's not a drama here on a Wednesday, but come on, you got to give me some new low yields on the bond market.
To me, the level actually has taken less interest, in my opinion, than the fact that we have not moved that much. The fact that it's been gentle moves every single day, and yes, they have all been lower. But to me, this sort of goes against the volatility that we had seen that was so extreme that a lot of people were saying we can't invest, even if we have conviction longer term. We don't even know what we're working with here.
OPEC News, Manus Cranny on that story, down 4.2%, 74.47 on American West Texas Intermediate. It is a wonderful tradition for us to right-size the airline industry, all that we hate it. Joining us now, Helene Becker, Senior Research Analyst at TD Cowen. Helene, let me just start with the basic idea. When does it get better? When does American aviation, not so much nostalgically, harken back to what we remember, but gets to a new, more constructive model?
Yeah, thanks, Tom. So I think we're in this period of time now for a few years where we don't have enough air traffic controllers. So anytime there's a rain cloud in the area, and a lot of the controllers we have are less experienced than the ones who are retiring, they slow things down, and they do it for safety purposes, but it's frustrating for passengers. You've seen in the New York area especially, but it will occur in other markets, the FAA asking the airlines that serve the market to cut capacity. So we've seen this trend to more seats per departure and fewer departures per day in an effort to smooth things out. And then just in terms of people traveling, I think people are tired of not being able to go away. And you've seen that, right? You saw it in 2022. You're seeing it really aggressively as people travel in 23. And we definitely expect it to continue.
On this weekend, with this weather, what are you focused on in the team at Cowen?
We're looking at the traffic numbers, and we're looking at where people are going. And what we're seeing is an increasing number of people going outside the country, actually, for the holidays with their family. I don't think people may be tired of cooking at home. They don't want to go to a restaurant for their Thanksgiving dinner. So they change their mind and they go traveling, and we're seeing an awful lot of that. And again, I think that's a good thing.
I'm looking right now at some prices to a couple of places, and they've come down really markedly. I mean, I'm actually surprised by how much lower they are this time of the year than last time of the year. There was a story on the Bloomberg talking about how airplanes have been actually increasing capacity in response to what you're talking about, the demand from the consumers, but they're having trouble now filling the seats. Are we seeing the shift that could really change the picture in a more material way for next year?
I think we are, actually. What we're seeing for next year is that domestic is going to be normal, whatever that is, but it will be normal seasonal travel patterns, more so than we've seen in the last few years. I call it 4 is the new 3, Lisa. Your boss wants you back in the office 3 or 4 days a week instead of 2 or 3 days a week. So it makes it hard to take that long weekend. Kids are back in school 5 days a week. So again, it makes it hard to just pull them out and go somewhere. So we're seeing that more normalized travel pattern in the domestic market. I think what you're going to see internationally is increased capacity because that's where the demand was. So you'll see fares coming down, especially in the North Atlantic and the Caribbean, Mexico as well. Those are 3 of the biggest markets where we see declines. And then we think there'll be a shift to Asia Pacific. Oh, sorry, Tom.
No, I think this is important, Lisa. You and I have been following selected flights, and I just look at one Newark to Paris. It's what everybody takes, and the answer is it's 1/3. You can fly 3 people now business class for what one business class ticket cost 18 months ago.
Yeah.
Stunning.
I look at Denver theoretically because some of the snow has started and it's really nice
well,
right
you
now.
think it's Paris, it's Denver.
Yeah. That's okay. Helene, I am curious, as we talk about the potential for prices to go lower, where the breaking point is for some of these airlines. We talked about some of the contracts with pilots, with other staff. All the prices are going up dramatically of the work staff. The base costs are going up as well. Put oil aside for 1 second. How difficult is it to make that break point for some of these airlines as prices start to come in?
Yeah, we're going to see margins get squeezed. No choice but to raise your revenue. And it's hard to raise revenue because especially in the domestic market, people will opt out. And you can't. I've done this for a long time, as you know, and you can never lower fares to offset volume declines. It just doesn't work that way. And so we'll see margin pressure. And we don't think airlines will make as much money in 2024 as they earned in 2023 as we revert to a more seasonal and normal pattern. I liken it to the cargo industry. Look at what happened with FedEx and UPS over the last 1.5 years or 2 years.
Right.
Volumes are down and revenues are not up as much. Revenues are down, costs are up, and margins are under pressure.
Well, that said,
why wouldn't that happen?
Do you run away from the industry? I mean, I'm trying to get my airline stocks back to where they were pre-COVID. Good luck with that dream. Yeah. Is there a single best buy, or do you just walk away from the sector?
It's really hard, Tom, because the stocks are at 2020 lows or below. Our best idea for 2023 was United. We had some good success with that most of the year until we didn't. And then we really like Copa, CPA, which is Panama-based. Everybody thinks, oh no, Panama, but there's actually a lot of really good things. It's a $3 billion market cap company. Panama is a sea-level airport, so you don't have the weather-related delays. There are a lot of U.S. expats who live there. They rely on the U.S. dollar. They don't have their own currency, so they can only spend what they earn. The canal would be the largest employer, as you would imagine, and then Copa would be the second largest private employer, followed by the airport. So it's a really well-run, well-positioned airline with a dividend, around a 3 or 4% dividend yield, and that dividend goes up almost every year as the family, the shareholders pay, or the company rather pays out 50% of adjusted net income. So that's a good one to look at. A couple of others.
Yeah, Helene, thank you. We are so grateful that you're here on Thanksgiving, and I am wondering, are you traveling on Thanksgiving? Do you ever travel on Thanksgiving?
That's so funny, Lisa. Normally we do, but I couldn't take it this year. I've been on the road every single week since August 1st. And when I looked at all our kids are traveling. They're all gone. My son and daughter are together with my son's baby and his wife, and My stepkids are visiting their in-laws, so it's like, I looked at my husband, I said, no, we're staying home and I'm not eating turkey.
Elaine Becker of TD Cowen, thank you so much for being with us. Yeah, exactly. I'm staying home and I'm not eating turkey. Yeah. Spoken like a veteran Thanksgiving experience.
I look at COPA here and, I get the idea, and others have said this is a wonderful, distant experience. 10-year track record, negative 3.8% per year. All it is Helene Becker's industry, the airline business. It's a tough business.
It is so hard, and it's only getting tougher. Yeah. Coming up, we're going to talk about those jobless claims, which I'm excited to do, given the fact that is going to be the data point, Tom, that we had been expecting.
Veronica Clark, Ira Jersey with us, a special guest later on. Bloomberg on a Wednesday before Thanksgiving. Good morning.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Bloomberg Market Surveillance, Lisa Bramwitz and Tom Keene. John Farrow, in preparation for the 9 o'clock hour, look for his important segment, Turkey, the day after. We'll have that Friday leftovers. Looking forward to that. Jobless claims. Now, McKee out with us. He's making a 5-step cranberry sauce.
Oh, is that so?
So I got to take the morning off. I got to do the pre-do on that. Jobless claims, and I'm sorry, it's become a big statistic in terms of getting the narrative forward.
The high-frequency data highlighting just what might be happening under the hood when it comes to the labor market, and we do get a read, and it comes out 209,000 jobless claims. That is down from 231,000 the previous month, and that is down from the expectation of 227,000. So this was actually a better than expected initial jobless read, and fewer jobs being lost.
Fewer claims, yeah.
But then there's this question of small revision upward. Is this good news or bad news? And I know Stuart Kaiser would kill me for saying that, but you have to imagine you're going to also kill me for saying that. But at what point is this sort of pointed to resilience that might kind of, challenge some of the rate cut discussions we've been having?
An immediate lift to the market here. NASDAQ up 0.4%. Futures up 12. Don't want to overdo that. The bond market, maybe a continued churn. I'm watching the 2-year yield, 4.87%. But we've got the claims and continuing claims clearly indicating in that direction. Veronica Clark to be with us in a moment, here to give perspective. And then durable goods, a little bit soggy there. I take John Hatzius at Goldman Sachs taught me to take a 3-month moving average on durable goods, which is too much math for Wednesday morning before Thanksgiving. But there it is. And to be honest, Lisa, the Michigan statistics at 10 a.m., and I agree with you, inflation expectations there is germane.
Yeah, although I have to say, the response that we've gotten in the bond market is surprising to me, because you actually see yields lower on the day, even though you're getting a better than expected labor market, which really calls into question just how quickly demand can continue to go down and just how much we're going to see a potential risk of at least resurgent prices next year. These, to me, are some of the questions that I know people are asking, especially when you have a full sweep of better than expected employment data.
And the oddities that we have here, so much coming up. Amrita Sen will be with us here in about 15 minutes on the shock of OPEC and oil. West Texas, $74 a barrel, down 4.2%. Brent crude under $80. Amrita Sen in a bit. Veronica Clark will join us here on the American economy. But first, a snapshot on his outlook for next year. Ira Jersey joins us. He's really helped surveillance this year with perspective. Ira, your outlook for next year, give us a capsule of that.
Yeah, so my view is that the Federal Reserve is done hiking, and eventually it will start to cut interest rates. I think that the market perhaps is a little bit ahead of itself in terms of what it's pricing for cuts, because as the minutes showed yesterday, I suspect that the Fed is probably going to be reluctant to cut interest rates unless we have a very deep recession. So in an environment like that, you can wind up seeing the yield curve remaining pretty inverted, or at least a little bit inverted throughout all of next year, with the front end kind of pinned where it is and the long end potentially seeing a bit of a rally. So treasuries could have a good year even if the Federal Reserve is on hold, because the expectation is going to be for the Fed to cut in 2025 or even start earlier in 2024.
Ira, I got to say, I'm actually really surprised at today's market move, the response in markets to an initial jobless claims report that came in below expectations. This normally, in a normal world, should be a positive downside surprise, considering this means fewer people are losing their jobs. Continuing claims showing the same trend. Why isn't this being viewed as a challenge to the idea that the Fed can cut by a full percentage point next year, and that we're going to see some sort of downturn?
Well, with jobless claims at 209,000, that's a good job market, right? That means people aren't losing their jobs at a quick pace, and so you have seen it's not a very big move, right? There's not a lot of liquidity in the market day before a holiday, but you did see 2-year yields back up a little bit, right? Maybe in anticipation of the market saying, well, the Fed's not going to hike necessarily, but maybe where the pricing for May and June cuts in next year might be a little bit too pessimistic on the health of the economy. So, obviously things like the 4-week moving average is what I tend to look at for claims, because it is very noisy and it is very seasonal. But 209,000 is certainly suggestive that the job market is still reasonably robust.
Do you think that the slowdown that we've seen so far, especially given the robust labor market, is sufficient to curtail inflation enough to even get cosmetic cuts that people are talking about from the Federal Reserve?
Well, I don't think that there's going to be cosmetic cuts. I think the idea that the Fed's going to cut, 25 basis points and try and be really cute and calibrate is not something that is in their standard operating procedure. I think it's much more likely that the Federal Reserve is on hold and then cuts more aggressively when it feels it needs to because the economy is falling out of bed. 209,000 jobs being created probably isn't good for things like service sector inflation, which is still the sticky part of inflation that's maintaining inflation well above 3% in aggregate. So I think that as long as you have a good job market, it's going to be a sign that the Federal Reserve is going to be on hold.
Ira, help the business people watching, including in beleaguered real estate. Tell us the trajectory of the real yield. The 10-year real yield, 2.50 peak. We had PGMON, I believe, yesterday, and they're really looking for a plunge in the real yield well under 2%. Do you buy it?
Yeah, I do, and actually that is our forecast for next year, that by the end of next year, we'll probably see real yields kind of in the low one handles, so call it 1.25 to 1.5% for 10-year real yields. Well, you say, wow, it's 100 basis points. I think it's going to be difficult for inflation break-even, so basically the tips gauge of what inflation is going to be versus where nominal Treasury yields are, to come down much lower than where they are today at around 2.2% on a 10-year. I don't see that going below 2. So if we're going to have the rally in the Treasury market we think we're going to have next year, almost all of that is going to come from the real yield side.
Away from tips and trying to make money here, the speculation of it all, Ira Jersey, what does that low real yield mean for the American economy, for business, the incentive to invest?
Well, it should actually increase, it should make financial conditions somewhat better, right? So one of the drags on the economy right now, which is what the Fed wants, to be fair, is to have real yields be an impediment to very fast economic activity, right? And that should help to arrest inflation. But even at 1.25%, 1.5%, compared to the last 10 years, that's actually not particularly high, right? And it's also not particularly low. Remember, not so long ago, we had negative 2% real yields. So positive real yields, I think, in general, is still a sign that the economy is healthy, but maybe not growing at the same pace that it was before.
Got to leave it there. Thank you so much on this Wednesday, Ira Jersey, for joining us with Bloomberg Intelligence. To take that over to the American economy, Veronica Clark joins us, of course, a movable feast from a high interest rate regime down to something lower at Citigroup. If we get that low real rate, Veronica, I would suggest many are not prepared for the incentives that means for the American economy.
Yeah, I think if we get that lower real rate, though, it's because we've seen a weakening in activity data. It's because we've had tight financial conditions up until this point because inflation has been high. And at some point, that should weigh on activity. We probably do get some type of broader downturn in the economy. And that's then what gets real yields lower.
Veronica, this jobs report really speaks to the narrative that you guys have been talking about, which is essentially that this economy has a lot more momentum than people are giving it credit for. How much do you think that story is being ignored in current pricing?
Yeah, we've seen an incredibly resilient labor market, and I think for the last year, really, people have been trying to poke holes and explain why the labor market is secretly weaker than we expect it is. But the data have just been incredibly strong, and I think we have to trust that. I would worry, though, that these things can have some non-linearity to them. We have seen the unemployment rate starting to rise, and that could be an early sign that things are slowing down. And it could be quick, when things do slow down. But yeah, so far the data have just been incredibly resilient.
What's the connection between a resilient labor market and inflation? Is there any correlation between a labor market that hangs in there and inflation that remains sticky?
Oh, absolutely. Yeah, I think the labor market is really the fundamental driver of strong activity right now. It's why people are still spending, and it really is the fundamental driver of wage growth that really seems, to be running maybe 4 to 5% and maybe kind of stuck there. And that kind of wage inflation is not consistent with 2% price inflation. That's more like 3 to 4% price inflation.
Is there evidence that a monetary authority can lower wage growth inflation?
Yeah, sure, by really weakening the labor market. We have still an imbalance, I think, of demand and supply in the labor market. Of course, the Fed has been trying to get job openings lower, but they're stuck at something around 9 million. That's much higher than they were pre-pandemic.
Veronica, come on. You're asking for some gloom recession stuff, and everybody's modeling out this baloney phrase, soft landing. A soft landing doesn't bring wage inflation down, does it?
No, definitely not. I don't think this ends in a soft landing. It's either, a harder landing, something we would call a recession, the unemployment rate rising, or you're just stuck at too high inflation.
Yeah, this is the heart of the matter, Lisa. I mean, a beautiful summary there by Veronica of, you know what? You want wage inflation down, as Earl Davis said. You know what? Soft landing doesn't get it done.
Which raises this question, either is the market basically overly sanguine that either the Fed is done raising rates or that rate cuts are a positive for risk assets? Veronica, which do you think is the way that we're going to end up seeing the market evolve? Are we going to see the Fed be prompted at least to talk about raising rates again, or at least hold rates at 5% for the remainder of the year? Or do you expect there to be that nonlinearity that we see all of a sudden?
Yeah, I think we'll end in the latter. And the Fed is still trying to talk the hawkish talk for now. We saw this in the minutes yesterday, still talking up the idea that maybe they need to tighten more. But I think they probably are done. I think everyone really agrees on that. But yeah, I mean, until you see some slowing in inflation, which I don't think you really get without the weaker activity, then yeah, rates will stay high. There's really not the reason to be cutting.
Veronica, thank you so much. Veronica Clark with us with Citigroup there, and we'll look forward to their outlook and their view forward into December as well. Pretty much stasis here. Futures up 12, Dow futures up 33, NASDAQ up 0.4%, Russell 2000 takes off up 0.5%. The VIX, 12.99. That's what I define as a bull market. You can give me this intermediate bear market stuff. You can't do intermediate bear market with a VIX of 13.
You look at the VIX, and I look at the MOVE index, which is the implied volatility in bond yields, and you're seeing in 10-year Treasury yields, and you can see it's come down dramatically from recent highs, and you've seen that just represented in the lack of extreme motion in the full faith and credit. To me, that's underpinning a lot of the safety that we've seen.
On a Wednesday, full faith in OPEC, 74.58 down $3, 4%. On American oil, Brent crude slides below 80. Amrita Sen coming up. That's going to be a huge, huge deal. SPX down 0.2%.
And we talk all about oil and how it's been the big miscall of the year. It's the big miscall of every year. It seems like we always get it wrong, and how much it is tied to weather and the idea of not understanding the changes in supply and demand. But really, in this case, there is a big question, about China, how much oil they've already stockpiled and aren't necessarily buying, even if their economy is recovering, right? There's that kind of trend. But then there's also the fact that the U.S. is producing record amounts of oil. How much does that offset some of the cuts that we've seen from OPEC Plus?
I just think as part of the commodity story, and when I got global demand, the shock, we're getting all sorts of outlooks in, folks, not even enough time today to go through them all, but the J.P. Morgan, Bruce Kasman Global Economic Outlook, it's a zillion pages, 15 people put it together. Bruce didn't do any of the work. Everybody else did the work, Lupton and the rest of them. But the answer is, I don't believe I've ever seen a 2.1% global GDP for 6 months. And that goes to the China statement that we heard from NVIDIA, that, and maybe I'm underplaying the slowdown in China. I may be wrong on that.
No, I think a lot of people would agree with you, and we have seen this in earnings reports. It's just how much is the extraordinary outperformance of the U.S. economy offsetting that, right? There are all of these cross currents that are so hard to pin down, which is the reason why oil has been the biggest defier of all market narratives. I don't really understand exactly what this OPEC Plus delay really means. I'm really looking forward to talking with Amrita Sen.
Huge response here. Just huge response here to what Pharaoh's cooking up for the 9 o'clock hour. We're going to do meatloaf, but he's doing turkey leftovers. Pharaoh.
Turkey loaf?
Yeah, he's got 11 different ways to do leftovers for
What
turkey.
do you do?
I'm looking forward to it. What do? I eat as fast as I can. 12 leftovers, I was wrong. Surveillance correction. 12 leftover turkey recipes. Look for that in the 9 o'clock hour. Amrita Sen next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact
impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I do think that there is a concern that we'll see further cuts. Already, the Saudis, Russia have extended their cuts, voluntary cuts, to the end of the year. But we've seen now in oil prices, unlike the product prices, we've seen an absolute collapse in the front end of the curve.
That was Stephen Schork, principal at the Schork Group, talking about what has confounded most people this market, which is oil prices at a time where we were supposed to have a slowdown that didn't happen, and then we were supposed to have a war that would boost the price of oil, and it did not. What we are looking at today is a quiescent market, to use your word, Tom. I like that word.
It's really Greenspan. Kind of stole it from Mr. Greenspan.
It really gives a sense of sort of a lack of drama underneath the hood here. S&P futures up 0.3%. Yields just nudging lower every day for a number of sessions in a row. 4.39% on the 10-year. And oil, we are going to get to in just a moment, but oil prices lower by more than 4% on the NYMEX, $74.54. Before we get there, I do want to just bring up Deere. Tom,
please.
They came out earlier with earnings that were disappointing. You are seeing a significant response in the shares, with shares lower by more than 5% at one point, if we can pull it up and take a look. But what we're looking at is a company that is seeing less demand from a lot of farmers, in part because they already had equipment that they front-loaded, in part because prices of crops have gone down, and they don't have the conviction that they're going to need to plant as much as they were in the past.
And Dennis Gartman would say that it does go back to the price of corn, the price of wheat, and the rest of it. Of course, Deere with a pandemic moonshot, 100 up to roughly 350, and then really been range bound here. But I take your point here. What's interesting here for Global Wall Street, we welcome all of you today, is White, Sandy, Fried, 777 pages. And the companies that they use within that Arch accounting textbook are Caterpillar and John Deere, because they can fold in how you pay for the tractors, which is equipment leasing.
Yeah.
So you can fold right in. And I take the point here. I'm glad you brought this up, because it's like FDX. It is a bellwether for the American economy. It's essentially a Boeing equipment without the equivalent without the romance.
And if you take it a step further to a point that you've made before, Tom, and I think it's a really important one, that prices are going down, and this is weighing on
goods.
The company, on goods, and on the ability to invest in a significant way. That nominal price that you talk about, how it benefits corporate earnings, we're seeing the flip side of that in a disinflationary environment.
Listen to you. I mean, you're taking the Kool-Aid and the.
I listen to you.
You got to stop doing that. I mean,
well, I mean,
listen to Pharaoh at least.
Let's listen to him.
I wouldn't listen to me. I'm trying to get there. I got it up. Corn here from the peak. $8 a bushel, we're all going to die. Amrita Sen's going, why am I on? They're quoting corn. We say good morning to Dennis Gartman. Corn down 42%. 42%.
And there's less of a need for tractors. We'll park that conversation for the moment, but we do want to speak with Amrita Sen on a different commodity, co-founder and head of research at Energy Aspects, as we try to understand what's going on at OPEC+. How do you understand the delay that we're hearing about in the OPEC+ meeting that was supposed to take place this weekend?
I mean, look, we was already starting to hear rumors about that this morning. We've also been told that potentially the meeting could be virtual. The timing of COP, which is being held in Abu Dhabi, shouldn't be underestimated because it does really overlap a fair bit with the timing. The ministers have pre-meetings from the 27th, 28th. But really, the OPEC Plus, we understand, has been trying to push for additional cuts in Q1. Remember, just a bit of background, they already have cuts in place, including voluntary cuts, all the way through to the end of next year for the entire group. This would be on top of, and this would be on top of if Saudi Arabia and Russia were to decide to extend their additional voluntary cuts, right? But for that, they have certain issues with, like, there are new baselines for several countries next year. UAE gets a higher baseline, the 3 African countries get a lower baseline. That's where the contention is the African countries who are saying, you're already giving us a lower baseline, and then now you want us to cut even more from there. That just needs to be ironed out.
Amrita, I've got to cut to the Amrita Sen wheelhouse here, which is the microeconomics, the price theory of oil. There's a thing called oil demand elasticity, which is the how much do you move when you move. Amrita Sen, can you look at oil demand elasticity and begin to price in $60 framework for oil?
I mean, demand's going to be fantastic in those prices. I mean, look, even at $100 oil prices today, if you look at it versus 2014 levels, that's only equivalent to about 70. 2008 levels, it's like in the 40s. So, you know, inflation-adjusted oil prices aren't even high, even if they were to be $100, let alone 60. Yes, the economy is slowing, the global economy is slowing, but it is still growing, especially in the non-OECD countries. We've already accounted for non-OECD OECD declines next year because we have a mild recession in the US, Europe, Japan, Korea. About 1 million barrels per day of oil demand growth next year. So we've already accounted for the slowdown. $60 oil should help us with more demand than that, not less.
Okay, so then what's the view out 12 months? Are you loading the proverbial tanker here on Brent crude, or for that matter, a stock like ExxonMobil? Is there enough tension there for you to climb on board, or do you have to wait and see through December and through this OPEC meeting?
I mean, look, for prudent risk management, of course, you wait and see through the OPEC meeting. You're going to get a lot of headlines and noise ahead of the meeting, for sure, like you're getting right now. But ultimately, we firmly believe OPEC Plus will try and maintain balance in this market. They always have, and particularly with Prince Abdulaziz at the helm in terms of Saudi Arabia. And like I said, demand isn't, demand is still growing, even if it is slowing. And we can see that in products prices. Gasoline and diesel prices have continued to go up even when crude has come down. So we remain constructive crude for next year, but in the short term, the turmoil does mean, like you say, you never catch a falling knife, right? You just have to wait it out.
Amrita, can you help us understand the price response to what we talked about with the OPEC Plus meeting? Why are prices so much lower on the news that they've delayed it because they're asking certain countries to make additional cuts? Shouldn't that not be the case? Shouldn't it be higher if they're going to be making more cuts?
I think people are just very, very worried about what happened in 2020. Do you remember when Saudi Arabia and Russia just turned on all the taps, and the OPEC Plus deal fell apart for a month, and we had negative prices, of course, exacerbated by COVID. That's the fear that, is the deal falling apart? Like the market and traders in particular, they tend to be quite black and white that way, right? There's very little room for gray, and part of my job. It's just like they need some time because again, it's to convince certain countries, and everybody's asking me right now, is the deal going to fall apart? Are the Saudis unhappy? Are they going to flood the market? Those fears are completely unfounded.
I love the therapist role that you play as you talk to clients. It's okay, the world isn't falling apart. Let's take a look.
I do feel like that every day.
I can feel that.
I can feel that. Rita, just quickly here, you mentioned that this OPEC Plus meeting might be taking place virtually. Do you have any sense why?
Yeah. It was to do with really logistics around COP, and especially if it was before COP, right? Like all the ministers coming down to Vienna. If they'd already agreed on a deal, whether it's an additional cut, and like I said, a deal is already in place, right? What I think the market must understand is, even if they can't get an additional cut through, there is a deal already in place through the end of the year where the cuts are going to continue, right? So there's quote-unquote nothing to be worried about. If that was the case, there wasn't a need to come to Vienna, especially if they had to go straight back into COP anyways. I think that's one of the reasons why we heard about the virtual rumors. Again, these are all rumors at this stage.
Amrita, thank you for the brief. Amrita Sen of Energy Aspects here with oil. West Texas now down 4.1% as well. You know, you talk about over the river and through the woods, and you wonder what a gallon of gas is going to do, and that's a whole political element as well. I mean, do we get everything in the country down below $3? Excuse me, $4 per gallon? Dear, how much of the country is going to see $2.99 gasoline?
Oh, yeah. I mean, just taking a look at oil prices, they've come down dramatically. And you can really tell when you go to fill up your tank. I mean, right now, $3.28, the average gallon of gas in the United States right now. That is down from a high in September of almost $4 a gallon.
I wonder what rents will do as well. We haven't even talked about it today, but I'm sorry. The OER, the rental dynamic, the housing dynamic, we're completely jaded in New York City. Jonathan Miller tells us that. But the rest of the country, there's some real rent disinflation, I guess is how I'd put it.
How many different stories are there in each state, right? I mean, each location has its own story right now with slightly different microeconomics and really feed into how people feel, which sometimes seems at odds at the global overview of economics, right? Somebody in a different state with a higher unemployment rate and higher inflation might feel something different than someone in a different state with a different
Certainly
backdrop.
us jaded New Yorkers who don't travel and don't cook at home.
Who are you talking about, Tom?
As well. On behalf of Jonathan Farrow, he's got the whole hat on, the whole thing. On behalf of Jonathan Farrow, Lisa Bramwitz, and all of our team, have a safe Thanksgiving.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, you know, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Spent the last couple of weeks talking about a weakening picture for the labour market, jobless claims going higher, and then bang, big downside surprise on claims from New York City this morning. Good morning, good morning. Equity futures pushing higher by a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up. Great earnings isn't good enough for NVIDIA. The Federal Reserve wants to proceed carefully. And Sam Altman making a return to OpenAI. We begin with the big issue. NVIDIA validates massive gains.
NVIDIA's come a long way. These are really good numbers. Blowout earnings, revenue.
Not much surprise.
Overall, I think the tape was what most people expected.
Everybody was expecting already a strong guidance and strong numbers.
Not a lot of excitement in the stock price. The selling that came after is a byproduct of the fact that everyone expected this really significant beat. Investors have just become accustomed to such blowout numbers by NVIDIA.
There's significant demand coming for NVIDIA's GPUs even outside of China.
The stock did very well past month.
Just because of the space they're in their participation in the AI boom.
It looks like it is set to do well.
There's room for them to run up. NVIDIA has more runway ahead.
It's been the darling of this stock market rally all year. Joining us now to discuss is Apollo's Torsten Slok, Larry Adam of Raymond James. Larry, first to you, the winners of 2023, do they just keep on winning?
I think they do, John. I mean, if you think about it, what you saw yesterday, what you've seen from the big mega cap tech stocks in general has been the trifecta of good things, right? They've beaten on the top line. They've beaten on the bottom line because their margins continue to expand. And probably most important, they've continued to raise their guidance in the future. And when I look at valuations, right now, the valuations of those in aggregate are pretty much where they've been over the last 3 years. But over that time period, they've more than doubled the performance of the S&P 500. So they've been keeping pace with their earnings, with how good they've been doing in the market. So I think that continues into next year, where the market's clearly going to be challenged for growth.
That single name, 240% plus gains year to date on NVIDIA. The commentary on the south side, Evercore, just another run-of-the-mill blowout quarter for NVIDIA. Bloomberg Intelligence, NVIDIA's third straight double-digit percentage beat of sales consensus this year, and they've raised. Torsten, you put out a note in the last week. It wasn't about mega cap tech, it was about small caps. 40% of the companies on the Russell, negative earnings. Torsten, how unusual is that?
That is really unusual. I mean, what the big picture really here is that everything that's going on in the tech world, it doesn't happen in a vacuum. What's very critical about this situation is that we still have the Fed having rates at very high levels at the moment. And that's certainly having a negative impact across the board on companies that have no cash flows. So that's why even the forward PE for NVIDIA is, of course, also heavily dependent on whether we will have that slowdown that the Fed is trying to engineer. So I look at this from the broadest perspective of, well, the Fed is still trying to slow the economy down. And with that backdrop, it actually makes more sense to look at the trailing PE. And the trailing PE of the Magnificent Seven is about 50. So that also still leads you to the conclusion that these things are still, in my view, quite heavily overvalued.
It's Austin, how challenged are things going to get for the smaller numbers, the smaller names, the smaller companies, given that we just had jobless claims at 209, unemployment south of 4%, we just had a quarter of GDP growth close to 5%, and you've still got 40% of the companies on the Russell with negative earnings.
That is what's so incredible, Jonathan, namely that how can companies not make money if this supposedly is a booming economy? And if I type ECFC Go on my Bloomberg screen and look at what the consensus expects for the next 3 quarters, GDP growth is going to be basically 0.5% for the next 9 months. So with that backdrop, this expectation that everything will still be fine for the next 6-12 months, I think that's completely misguided. The Fed is trying to slow the economy down to get inflation to come down. And with that backdrop, we should expect rates higher for longer. So there's just a missing conversation about rates are actually going to still continue to have a negative impact on companies with high leverage, with low coverage ratios, and with generally weak cash flows. So I still think that high rates are going to have a negative impact on the economy, just like it's had on consumers, on corporates, and on banks. And I think that that process continues.
Larry, with that in mind, why would this rally broaden out anytime soon?
Well, I don't necessarily think it's going to necessarily broaden out that quickly. I agree with Torsten in regards to that. I do think we have a mild recession in the first half of next year. And that's typically when you start to see small caps start to pick up, right? Because it's a forward-looking indicator. So once we actually get into the recession, you'll start to price in the prospects of the recovery. So I wouldn't be overly bullish on the broadening until we actually see the recession actually occur.
Well, let's talk about the winner. NVIDIA, up big time year to date, reporting another stellar quarter. Ed Ludlow with us on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Just on the fiscal third quarter just gone, you know, a beat across the board against sell-side expectations, but also I'm hearing, you know, pretty comfortably against some buy-side expectations, which were much more elevated. In the third quarter, they booked $10 billion of net income, and the way that I think about it is that that's more net income than they booked in the entirety of full year fiscal 23. Remember when they were impacted by the PC slump? In other words, NVIDIA's shipping these H100 GPUs is the only game in town for that, shipping them at volume and doing it quite profitably. The outlook is key, right, for the fiscal fourth quarter, $20 billion of revenue plus or minus 2%. But even if you go with the minus 2%, they're still way above the average of analyst estimates on the consensus side. The story is about the impact of US technology export curbs. They are being impacted. Those updates on the policy side came late in the quarter they just reported. But what they're saying is that there will be a sharp drop in shipments to China in the fiscal fourth quarter. The way that the market seems to be looking at it, though, is that the guidance for that fiscal fourth quarter period could have been even better. They're leaving money on the table. And I just reiterate, we can go on this later in the show, they're supply constrained. In other words, that if they stop shipping to China, there is demand elsewhere that they can divert that supply to. That's a part of the equation. The long term with China is still a massive question mark.
Just absolutely incredible. Ed, let's catch up around the opening bell. Again, NVIDIA up by 242% year to date. Month to date, the month of November, we caught up with Jack Caffrey at JP Morgan. He had a great line on this. What a year November's been. Month to date on the NASDAQ, up more than 10%. On the S&P 500, up more than 8%. That's the equity market. Torsten, we have to talk about the economy. And in some ways, sometimes it's divorced from what's happening in equities. And you can see that just looking at delinquency rates, what's happening with the consumer. Torsten, are you still making the argument that that tightening is starting to bite? That you can see that, say, beyond jobless claims, which came in much lower than anticipated this morning. Are you still seeing evidence that higher rates are biting?
Absolutely. So think about the bigger picture here, that the Fed is still trying to get the economy to slow down. And what has happened in response to Fed hikes is exactly as you're saying, Jonathan. We're seeing delinquency rates going up on credit card and auto loans. We're seeing default rates going up for high yield and loans quite quickly in the last 6 months. And we're also seeing bank lending slowing down. That's exactly what the textbook would have predicted. The Fed is in the process of slowing the economy down. And the result of that will, of course, also be that earnings will slow down. And if we don't get that slowdown, the Fed will just keep on saying, like they communicated in the minutes yesterday, well, but then maybe we'll just be still considering hiking even further. So if we don't get the slowdown, call it organically where we are at the moment, well, then we may all be surprised that the Fed might then begin to re-hike rates again. In other words, the discussion really here is that this is all happening with the backdrop of the Fed trying to slow things down. And they are succeeding on some fronts. But I think a number of these developments are completely being ignored by the stock market, including these slowing things that we're seeing on the consumer, on the corporate, and on the banking side.
To some extent, Torsten, the Federal Reserve needs to be blamed for that. There is a takeaway in the last month. This labour market is no longer a reason for this Fed to be hawkish. Do you think that's the wrong way of looking at this labour market?
Well, I think there's a number of, I do agree with what you're saying. It is still a bit puzzling why jobless claims continues to be so weak, so strong and at these low levels. But what is important is that we've seen weakness in the unemployment rate. It troughed at 3.4, now we're at 3.9. It is trending higher. So, of course, we'll need to see another few months exactly what the weakness in the labor market is going to look like. But the number of job openings is coming down. The work week is coming down. You're seeing the WARN notices has also been softening. Across the board, a number of of the labor market indicators are suggesting that things will continue to weaken. We're also seeing youth unemployment has gone up quite substantially in the last 6 months. All these things point to weaker labor demand, which is exactly also the way that the Fed would be thinking about their rate hikes are working. It's just taking a bit longer time, partly because there were more excess savings and partly because of the fiscal stimulus that's still coming from a number of different fronts. So I still think that we should be thinking about this in terms of what is the Fed trying to do? They're trying to get inflation under control. That's also how we should be thinking about earnings.
Larry, if the answer to where is higher unemployment, is it still just wait, it's coming?
No, I think it is coming. One thing I'd add to those jobless claims numbers is, look at the continuing claims, right? They're starting to approach levels that we haven't seen in 2 years. And I think that that's really getting to the point that it's actually getting tougher to go find a new job. So I think that's going to start to slow. When I look at other spending activity, if you look at credit card activity, it's been flat to slightly down. So that shows me that the consumer's starting to slow their spending. And when we do our own survey for clients, it was kind of interesting that only 5% of the respondents that we had actually said they were going to spend more over the next 6 months. 33% said they were going to spend less. So that tells me that the consumer is really starting to slow. And as Torsten said, the reason it hasn't slowed yet is because we had that buffer of excess savings. Well, that buffer has pretty much been evaporated, and I think it's really going to start to bite as we sit here right now.
Larry, we heard from some retailers, a whole bunch of them actually, in the last week or so. Are you seeing that in the earnings, the commentary from those companies?
Yeah, I think what you're seeing there is that it's a struggle on the top line. They're beating their current earnings by having expense management and working down their inventories. But if you look at guidance has been very soft for each of those major retailers. And I think that that is a sign that they're seeing the consumer really weakening. In fact, one of the other things that we look at is what kind of hiring did they do for the holiday season? And a lot of their hiring has been a lot weaker than what you typically see. Again, a sign that the consumer is really starting to weaken here.
Let's continue this conversation. Larry Adam, Torsten Slok, sticking with us. Need to throw in some calls for next year as well on the S&P 500. Bank of America yesterday, Savita Subramanian, 5K year-end next year. RBC's Laurie Cavacina, 5,000 year-end on the S&P next year. We'll get into those calls in just a moment. The broader market on the S&P positive by 1/3 with some movers going into the open. Here's Abby.
Well, certainly helping that push higher for the futures, John. Let's take a look at some of the winning stocks on the day, including NVIDIA, which you've all been talking about on that blowout quarter. But the fact that after that 50% revenue guide higher back in May, the guide higher by in the teens percentage this time around, not so much. Ho-hum, the stock up just slightly. Microsoft up 1.3% as OpenAI is bringing back Sam Altman and overhauling its board. This is seen as a positive for the software giant, putting them in the best position, according to some analysts around AI. And then Deere, a big laggard, down 5.3%. They put up a solid quarter. They beat both top and bottom line ranges estimates, but the profit range, the low end, 16% below the street on weakening demand for its equipment. This stock coming into today, John, down 11% year to date. So this weakness in demand, not a surprise to all.
Abby, thank you. NVIDIA, and thanks for that again, Abby. More from Abigail around the opening bout. NVIDIA, just up a little bit in the pre-market. I've mentioned this line a few times. Julian Emanuel, Evercore, before those numbers came out yesterday, Julian said, great isn't always good enough, at least in the short term, and that's what it feels like this morning. Coming up, the Fed agreeing to proceed with caution.
What we heard from the Fed in the November meeting was that the risk of doing too much versus the risk of doing too little is coming back into balance. The Fed, frankly, has a lot to be grateful for.
The conversation is coming up next.
CFOs are reshaping the C-suite, Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the Fed in the November meeting was that the risk of doing too much versus the risk of doing too little is coming back into balance. The Fed, frankly, has a lot to be grateful for. Broadly, investors have lots to be thankful for in addition to the Fed inflation coming down, the Fed on hold, all good things, but it doesn't mean we should take them for granted.
The Federal Reserve on repeat. The Fed will proceed carefully. That's the takeaway from the FOMC minutes. Here's the quote. All participants agreed to proceed carefully and that policy decisions at every meeting would continue to be based on the totality of incoming information. This is jobless claims deliver a downside surprise. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, what's in a couple of words? What does proceed carefully actually mean?
Yeah, so I think that means that they're done hiking, and number one. And then number two, it's really, they don't want to cut too early either, right? So I think the careful part of it is we don't want to make the mistake that we perceive that we made back in the 1970s, where we cut interest rates too early and too much, and that helped drive a second inflation wave a couple of years later. So I think when they say carefully, they really mean that they're on hold. I think the question now is how long are they on hold, and is the market getting ahead of itself in pricing for mid-year cuts?
Do you think we've finally got some bond market stability, Ira, for the wrong reasons?
I don't know necessarily for the wrong reason, and I doubt that the bond market's going to be particularly stable. That I think that the front end of the bond market, maybe 4.75 to 5.25, is where 2-year yields will stay. But I still think the back end is going to jump around based on how the incoming data is over the next couple of months. If the data continues to slow, as you were talking about in the last segment, then you could probably have a pretty big rally in the long end of the Treasury market. And in fact, I do suspect at some point over the next 12 months, we will get that. And we can have in the bond market, just given where yields are and what the outcome for the economy is likely to be, you can wind up seeing double-digit returns in the Treasury index. So the Bloomberg Treasury index could be up 11% by the end of next year from where it is today.
We've got double-digit returns month to date on the NASDAQ, Ira, and my point there is that ultimately they complained, pushed back against tighter financial conditions, or, if you wanted to be kind, outsource monetary policy to the sum of the moves we'd seen in the previous month. And now look at things. Equities have ripped. Bond yields are much lower, north of 5% a month ago, October 23rd, I think, and now we're back to the 430s. This is what Andrew Honhorst of Citi had to say. The officials at the Fed have responded asymmetrically to tighter as opposed to looser conditions. Ira, is it hard to disagree with that?
I can't disagree with that. I do think that the Fed is worried about going too far and pushing the economy into a much deeper recession. So I think they kind of breathed a sigh of relief when the bond market did do some of their work for them and tighten financial conditions in August and September. But of course, as you mentioned, John, we've come back and financial conditions are much more neutral right now. Over time, the bond market is going to respond to the inflation data data, certainly, but also shifts in expectations for the Fed. And I think that's what you've seen with the market now pricing, once again, cuts by the middle of next year. That's going to cause 5-year notes and 10-year notes to have somewhat lower yields than they would when we had priced out almost every single interest rate cut for 2024. The market's been very fickle, right? So the market's been on edge with every single piece of data as well. So, once we get the November payrolls report and we get the November CPI numbers, you can wind up seeing the market reprice even more with, 25, 30 basis point moves and 10-year yields would not be a surprise to me at all, given liquidity is so poor, and we're going into a poor time of year for liquidity. So, you're going to have a double whammy for how big you can see yields move over the next month or so.
We can wave goodbye to that stability all over again. Ira, thank you. Ira Jersey of Bloomberg Intelligence on the bond market and the Fed minutes we got yesterday afternoon. Torsten Slok, I want to come back to you. 2022, you speak to an official at the Federal Reserve, and you'd hear this in various different ways on repeat. The risk of doing too little outweighs the risk of doing too much. As we get to the end of 2023, Torsten, from the Fed's perspective, has that assessment changed?
And I think the minutes yesterday exactly spelled out that they are still very worried about not getting inflation quite yet under control. I think that the big difference between how the Fed looks at things and the market looks at things is that the market is saying, oh, well, inflation is indeed coming back to 2%, whereas the Fed is actually saying in the minutes yesterday, we need further evidence to be convinced that we are on the road back to 2%. So in that sense, the Fed wants to be 100% sure that inflation is completely under control and is completely at the 2% level where their target is before they begin to declare victory. And I think the market is underestimating the Fed's commitment to getting inflation all the way back to 2%.
So you're pushing back against the rate cuts that are priced for 2024. That's the Torsten Slok view over at Apollo. Larry Adam, I need to know, to understand from your perspective, whether that matters to an equity call for next year. I had 2 calls I mentioned before we went to commercial break. One was from RBC, 5,000 points year-end next year on the S&P. The other from Bank of America, Savita Subramanian. Bullish because of this. Bullish not because we expect the Fed to cut, but because of what the Fed has already accomplished. Larry, how would you address that one?
So I think that you're going to see a period of consolidation. I'm not disagreeing that the markets can go higher next year, but I think in the near term, the market's priced in a lot of good news. So for example, when you talk about the market's priced in 4 interest rate cuts for next year, we think there's only going to be 2. When you look at the earnings forecast for next year, consensus is like 220, 244. We're more in a tread water type of environment where we think it's 220, 225. When you look at the recession, the consensus is looking for a soft landing. We think we have a mild recession. And then the other thing, it's very important, is that you really can't keep rallying on the same news. And what I mean by that is that inflation is clearly, in my opinion, on its downward trajectory. But we can't keep rallying every time we get another number that just continues to show that. So I think there's going to be some challenges here in the near term. And the fact that a lot of these people are turning so optimistic, to me, that's a contrarian signal to be a little bit more cautious, at least here in the near term.
Larry, what does caution look like for you? How do you express that in markets?
Well, I think it's all about selectivity. The sectors that we like, I'd mentioned to you earlier, I still think you can stick with technology, because even if we do have that mild recession, I think the earnings growth will hold up there. You got to look at specific areas where there's a catalyst. I look at valuations, and the 2 places I would look there are energy, because I do think that energy prices will ultimately move higher over the next 6 to 12 months, and that'll help that sector. And then I do think financials. There's been so much bad news built into financials on the back of what's happening in the regional bank space potentially. But regional banks make up a very small component of the S&P 500. It's less than 1%. So I think you got to worry about that big headlines, but ultimately how they impact the respective markets that we're looking at.
I'm not sure what would have these banks at this point. It's been a difficult year. Larry, appreciate your time. Larry Adam, Torsten Slok, 2 of the best. Happy Thanksgiving, gents. Have a good Thursday. Appreciate it. Thank you. Thank you. Larry mentioned crude. Just want to touch base with what's happening in the commodity market. Brent crude's down more than 4%. WTI is also down more than 4%. We were expecting an OPEC meeting to take place this weekend. We now understand it's going to be delayed into next week. Manus Cranny is going to join us in about 8 minutes' time. He's going to break down why, what's happening, and ultimately what happens next at OPEC+. Coming up, the morning calls, and later, stocks closing in on one of the best Novembers on record. That conversation still ahead with RBC Capital's Amy Will Silverman from New York. This is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there to kind of upside.
About 5 minutes away from the opening bell here. Equities doing okay on the S&P 500, positive by about 1/3%. That's the price action. Let's get to some morning calls this morning. Your first one from JP Morgan, upgrading Clorox to neutral, seeing upside risk to consensus estimates and strengthening demand. Your second call from Morgan Stanley, downgrading Virgin Galactic to underway, moving to the sidelines given the company's limited catalysts. And finally, Williams downgrading Foot Locker to hold, expecting disappointing results at next week's earnings. That stock is down about 1.8%. Coming up, RBC Capital's Amy Will Silverman looking for some big gains for the small caps. That conversation up next. Your opening bell just around the corner.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So we get to ride in an Uber with the Uber CEO.
Yeah, that'd be pretty cool.
Come along with me, Emily Chang, as I ask tech leaders of today what makes their businesses future ready for tomorrow.
You're an expert. Okay, let's make a move. About 20 seconds away from the opening bell in New York City this morning. Good morning. On the equity market right now, futures positive by about 1/3%. Yesterday, snapping a 5-day winning streak on the S&P 500, but just a subtle, small, slight move lower on the S&P. But still, this month to date, we're up more than 8% on the S&P 500, easily the best month of the year so far. There's your opening bell. Switch to the board and get to the bond market. Yields a month ago through 5%. The 10-year right now down about a basis point or so in the 430s, 438.86. What a turnaround in this bond market, back to levels we haven't seen since September. In the FX market, the euro backing away through 109, then back down the other way, 108.77 on that currency pair. We're negative by 1/3%, just pulling back from those August highs in the FX market on that currency pair. And I just want to turn to crude. We should sit here in the commodity market. WTI in the 70s, $74 and about 30 cents. We're breaking lower by more than 4% this morning. Brent crude a break below 80 at 78.88. Delays to the OPEC Plus meeting, which was set to be taking place over the weekend. Manus Cranny joins us now for more. Manus Cranny, what is going on with this one?
This is a classic moment of where there's angst in the ranks. If you think about it, the Saudis are on the hook, Jonathan, for 1 million barrels a day of a cut. They've extended that to the end of this year. What are they going to have to do? It's called a lollipop, by the way. Prince Abdulaziz bin Salman pulled out his lollipop in the summertime and said, I'm on the hook. I'm going to do 1 million barrels a day of a cut. Now, at the same time, Sahil al-Mazrui in the United Arab Emirates has got the deal of a century. They've battled hard to be allowed to produce more. I want a higher quota. The UAE, I want a higher quota. I'm going to get a higher quota. They fought it out. They slugged it out 2 summers ago on Bloomberg TV, and he was given a higher quota. So the UAE has the ability to produce 200,000 more barrels. Now put those two together. I'm cutting by 1 million, and you're getting the opportunity to up your game by 200,000, and I'm maybe going to have to extend my unilateral cuts. That is where I think is the subplot of the angst. There are other machinations as well, Jonathan. Good morning.
You were due to go this weekend, Manus. Is this meeting even happening? Have you got a date for it next week?
Extend and pretend. It's thrown forward into next week. Jonathan, we understand on the 26th it'll happen. It means I'm coming to your house for Thanksgiving.
That's fine. I've already invited you. Manus Cranny, thank you, sir. It's good to see you. It's tough for energy right now. It's been tough for energy stocks more recently as well. It hasn't been tough for this one, NVIDIA. Let's talk about it. Delivering another quarter of blowout results, topping Q3 estimates and issuing another impressive outlook. Ed Ludlow back with us for more. Hey, Ed.
Hi, John. NVIDIA softer by 1/10%. Sorry, following Manus Cranny on this is hard. The stock is flat, essentially. We went into this knowing that NVIDIA earnings, the expectations were sky high. And they beat those expectations, right? Not just in the fiscal third quarter gone, but the outlook that they gave for $20 billion in the fiscal fourth quarter, plus or minus 2%, even at the low end of that range, is well above at least the sell side consensus. And so there is an impact here from US technology curbs to China, but there's also tangible evidence, and indeed it was in Colette Kress, the CFO's letter to shareholders, that they will more than make up the difference in the shipments to China they now cannot make by the sort of insatiable demand for high-performance GPU or AI accelerator in other markets around the world. And again, we reiterate that they're supply constrained. Big emphasis from Jensen Huang, the CEO, on their work in the supply chain, increasing volumes with their third-party contract manufacturers. And he was as bold as to say that through calendar 2025, not fiscal 2025, calendar 2025, that the data center business will continue to grow. The stock down 0.4%. You know, this is kind of relative to thin liquidity ahead of the holiday. It's a stock trading at 30 times forward earnings, up 240% year to date, best performer NDX and on the S&P 500. But it seems like there's room to run here from a market perspective based on demand right now for building large language models.
Ed, thank you. That right there is not even a dip in the ocean compared to what we've seen so far year to date, up more than 240%. NVIDIA pulling back by 0.5% on a session so far. Let's stick with tech. The saga, the soap opera of the last couple of days. Sam Altman returning as CEO in a dramatic U-turn at OpenAI. Wedbush's Dan Ives calling the events a win for Microsoft, writing this: "The street is glad this is finally over, and so is Nadella and Microsoft investors." We've got a record high on Microsoft. Abby has more. Hey, Abby.
We do, and it's the third record high that we've had this week. So investors cheering this. I think that's a little bit of a bold call on the part of Dan Ives, that if somebody would know that it's over, this Silicon Valley drama, if it's over, it would probably be him. What we do know is Sam Altman has returned to OpenAI, and I think that the sense is that that's more in line with what OpenAI employees had been expressing, along with big tech CEOs, after he had been ousted last Friday and then hired by Microsoft just days ago, and now returning. Relative to Microsoft and what it means, I think it's very much summed up by what Microsoft CEO Satya Nadella told Emily Chang in a Bloomberg television interview earlier this week, saying that he wouldn't oppose Altman's returning to OpenAI, that Microsoft has pledged $13 billion to OpenAI, so they benefit whether Altman is with Microsoft or if he's at OpenAI. Microsoft analysts seem to be incrementally more positive on the development. On the other hand, though, Jefferies' Brent Thill saying that basically it's going to have limited impact on Microsoft. But with that stock up 1.7%, another record high, investors seem to be pleased with this latest turn.
Abby, thank you. I'm not sure if that was hope or conviction or confidence from Dan Ives of Wedbush. I think it's hope for all of us that we can stop talking about this story. We'll talk about it again, though, in about 10 minutes' time with the likes of Ed Ludlow and Mandeep Singh, who's been brilliant on the Microsoft story. We'll catch up with them in about 10 minutes' time. Let's turn back to earnings. Deere forecasting a smaller than expected profit next year, signaling slower demand for farming equipment. Isabel Lee on top of this one. Hey, Isabel.
Hey, John, shares are down dramatically for Deere, the latest company to be a victim of surging rates. Investors are reacting to the smaller than forecast profit that the company said net income will be between $7.75 billion to $8.25 billion next year. And the full year outlook, it's also well below estimates compiled by Bloomberg. Now, Bloomberg Intelligence said that the wildly disappointing guidance was weaker than expected. So Deere is the world's largest tractor maker, John, but it still can't really hide from this surging environment. Farmers are now less willing to buy equipment because they're squeezed. Their budgets are smaller, higher borrowing costs are really deterring them. And if this decline holds, Deere is on track for its biggest fall since April, and the company is on track to shed more than $6 billion in market cap. Now you can see that the gains are just dropping. The loss is now dropping. It's shedding around 6%. John.
Big numbers in the wrong direction. It's about thank you. It's a break of 360 in early trading on that name. About 6 or 7 minutes into the session, your S&P is positive. It's up by 0.6%. On the NASDAQ, we're up by more than 1%. We're doing okay there, that's for sure. The retailers, a mixed picture, that's for sure. Shaky week for a whole bunch of them. Guess, Urban, Nordstrom, all delivering a cautious outlook with warnings about the U.S. consumer. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, it's been a tough reporting season for those retailers today. Obviously, no exceptions. Let's start with Nordstrom, because profit, it actually beat expectations. You had lower markdowns, better inventory management, but you had revenue falling short with a bigger than expected drop in sales. That's leading shares almost 5.5%, 6% lower or so. And that looks mild compared to what we're seeing specifically at Guess and Urban Outfitters. Looking at Urban Outfitters, it actually reported a comp sales miss at the namesake brand. That is overshadowing some good news from its Anthropologie and its Free People brands. And then Guess, it's down double digits this morning after missing on revenue and cutting its full year EPS guide. So at the tail end of this retail earnings season, John, it seems like there's two broad themes. You have same store sales misses. You also have a real struggle to generate that sales growth that we had been getting used to. So we'll see how this holiday season
And
goes.
just a total lack of confidence about what's coming next. Katie, thank you. Katie Greifeld there with Nordstrom down 5%, Guess down by about 13%. Amy Will Silverman of RBC looking ahead to next year. Here's the quote: "Nobody is really positioned for a sharp gap down in the market that has made selling volatility attractive." Amy joins us now for more. Amy, I'm going to ask you the question you get asked all the time by clients. What is the option market saying about this rally continuing? What is it saying?
You know, what's interesting this time is it's quite bullish, but it's a little stratified, John. So the options market is really fixated on small caps right now. We use IWM, the Russell 2000, as a proxy for that. And I can tell you, you know, this is an area where I feel like equity strategists have had fits and starts, you know, calling when we're going to see that rally in small caps. But this time around, the options market is sort of behind it as well. And you really see that in historic call buying in IWM. And as we have learned from mega cap tech, and we've learned from the meme frenzy, when options get involved, it can continue to buoy that rally even further.
So let's talk about IWM. So this is the Russell 2000 of small caps. We just had Torsten Slock on from Apollo, who pointed out, Amy, that 40% of the companies on that index have negative earnings. When you look at the appetite there in the options market for something like that, is that an investor base that wants to rent the move higher or own it into next year?
Yeah, that's such a great question. And, the way we think about answering that with options is we can look at tenors anywhere from, 1 week up to 12 months. So if it was really a rent the rally, I'd say you'd see that in the short-term options pricing. But we are seeing it across the board, across all tenors. So it's not just call buying in the 1 month and under space. It's call buying across all those tenors, even longer term. And our own equity strategist, Laura Calvicina, is more behind this fundamentally as well. She mentions a lot of these debt maturities, these debt walls are actually a lot further out than people think. Over 4 to 5 years. It's not a maturity wall that's coming next year. And obviously you have those negative earners in that. That hasn't changed, but fundamentally those balance sheets have gotten better. And we do see that echoed in the options market, which again, we historically actually haven't. This is the first time where both of those things are aligned.
You mentioned, Laurie, 5,000 points on the S&P. Year-end next year is the price target over at RBC. Hopefully we can catch up with Laurie before year-end. I want to catch up with you, Amy, about something you and I have discussed a lot. The economist who cried recession. The hedges, as you've pointed out multiple times to us here at Bloomberg, just haven't worked. Going into next year, burned by some of that. What are you advocating for now?
Yeah, it's one of those tough things where you just don't know when the music's going to stop, John. And so while the music is still playing, we still see people selling volatility for yield enhancement. That obviously creates this suppression of volatility in the market. You have a VIX at a 12 handle right now, I believe. And here's the deal, what the options market is not positioned for at all is a sharp gap down in the market. There's very little hedging, very little positioning. I don't blame people because it hasn't worked, but that doesn't change the reality that tails are really inexpensive. And that continues to be the case as we go into 2024. Look, I don't think that people are going to take advantage of that, but that doesn't necessarily mean that people shouldn't be taking advantage of that.
That's downside protection. Can we talk about the upside, somewhere to play? Amy, you pointed out China. As everyone knows, we came into this year and a lot of people were very constructive about the reopening. That's where the big growth would be. And it's been completely the opposite. China's disappointed, and America has delivered a monster upside surprise in GDP growth relative to the recession call that was widely expected coming into this year. Amy, as you start to think about the equity play with all of that in mind going into 2024, how are you approaching that? The international China call?
Yeah, I've been thinking about that a lot because at exactly this time last year, I was on a road show in Europe, and I remember the consensus play was China rebound. So we know that the markets, John, operate on Murphy's Law. Whatever causes the most pain to most people is probably what will happen. And I can tell you right now, there's no consensus around China rebound for 2024. And so when you look at that options positioning, I ask myself as a derivatives person, what is not priced in? It would be very attractively leveraged if we get that upside. It's those FXI calls, that proxy for China, as well as those individual names. There's very little positioning in that. If we get any sort of tailwind there, which people had expected exactly 1 year ago, the leverage to those upside calls should be very, very well played.
One to watch for next year. Amy, great to catch up. Happy Thanksgiving. Enjoy the weekend.
Happy Thanksgiving.
To you as well. Amy with Silverman there of RBC. Just to put some numbers on that, the CSI 300 equity market in China, Shanghai Shenzhen, is down by more than 8% year to date. Compare that to the S&P 500, which is up close to 20 percentage points. That's not the kind of gap or the direction of either of those stories we expected at the start of the year. That's the equity market year to date. Let's talk about it on the session. On the S&P up by about 0.6%, on the NASDAQ up by about 1 full percentage point. Coming up, the saga, the tedious soap opera of the last week. Sam Altman.
Great irony is people are so worried about AI destroying all this stuff. It was human nature. The demand and the outpouring and interest that you've seen and the support for Sam is just absolutely unprecedented in a tech company.
A dramatic U-turn in the open AI drama. That conversation up next.
business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think that the demand and the outpouring and interest that you've seen and the support for Sam is just absolutely unprecedented in a tech company. It's almost like an unintended pre-IPO roadshow. The great irony is people are so worried about AI destroying all the stuff. It was human nature. It was a bunch of people in a room, and the emotions that drove the sort of whimsical and capricious decision to say we're going to oust this beloved leader in tech. People partner with a company because they trust it, and this weekend, trust blew up. So it could take 10 years to build a reputation, 10 years to build trust, and 10 seconds to lose it.
What a mess. Silicon Valley waking up this morning and asking, was it all just a bad dream? OpenAI reinstating Sam Altman as CEO and hitting go on a board shakeup, tapping former Salesforce CEO Bret Taylor and former US Treasury Secretary Larry Summers. Microsoft CEO Satya Nadella endorsing the decision on social media, posting this: "We believe this is a first essential step on a path to more stable, well-informed and effective governance." Let's get the team coverage. It starts right now with Ed back in San Francisco, Mandeep Singh in New York City. Ed, are we done now? Is this finished?
No, the story is not over, Jonathan. I mean, the key points are that there is a new board in place, right? And Bret Taylor, as you said, former Salesforce co-CEO. Remember that he was chairman at Twitter when Musk was buying Twitter, the company now known as X. Larry Summers, you know, are known to this show, to this network. But the thing is that we don't have a definitive answer on the governance changes. You know, you showed the Nadella tweet, but what we're hearing from sources is that expanding the size of the board was just the first step. We also never found out why Sam Altman was fired by the original board in the first place. And a big part of the still to come is an internal investigation about that process. And then, you know, the overhang that there is a tender offer in the hundreds of millions of dollars that's on hold right now was due to be done and wrapped up pre-Thanksgiving. And on the table is life-changing amounts of money for those OpenAI staff that staged the mutiny. So is it over? I don't think so, based on what I'm hearing, John.
And Mandeep, there's still a few questions, and a lot of the questions people have are directed at OpenAI. I think, Mandeep, the question I have is directed at Microsoft. There's been a reluctance, I can sense a reluctance, to criticize Satya Nadella and Microsoft, and understand it. He's been such a phenomenal CEO for the best part of a decade. But Mandeep, how did we get to a position where Microsoft invested this kind of money, took this kind of stake this big, and didn't get anyone on the board and doesn't have any knowledge still as to what happened?
Yeah, look, I think the time when they partnered with OpenAI, at that time they wanted to be the first one to, get their hands around this large language model, which was obviously new early in the year. And I think they didn't really pay that much attention in terms of, the governance aspects or getting a board seat. And look, this is still a better outcome than, bringing Sam Altman and OpenAI employees on board, because there is a lot of IP in OpenAI, and that would have just disintegrated. So clearly, they've salvaged the situation, but there's no way that they're going back to where they were, because look, I mean, there are other companies that will catch up, and this puts doubts in the minds of, companies that are integrating, OpenAI in their stack. This is at the foundational level, just like your NVIDIA GPUs. And now you'll be thinking twice, should I really standardize, or is it stable enough for me to trust that nothing will happen going forward?
Mandeep, just to build on that just a little bit more, will this change the way money's invested from Microsoft's side of things in the future?
I think there could be an approach where Microsoft develops its own foundational model similar to its chip ambitions, and they could say, okay, if we're not just going to go all in on OpenAI, and clearly I can see that happening as a result of this.
At the future of OpenAI, you're going to discuss it later, no doubt, with Caroline Hyde on Bloomberg Technology, but let's talk about it. It was the Go Fast group and the Go Slow group. Is it going to change the approach of the overall company given events of the last week?
It kind of has to. I mean, I have a lot of calls out to a lot of the investors. I'm pretty confident that some of them will be coming on the show, but let's wait and see. People got very surprised by this. Remember what Nadella said, surprises are bad. Just to Mandeep's point, to give you a concrete example, the agreement between Microsoft and OpenAI was such that the board, as it was Friday, was supposed to give them a heads up if there was any M&A opportunity or proposal. Well, there was over the weekend. There was an idea that OpenAI would merge with Anthropic, and yet Microsoft wasn't given a heads up. The investors were concerned about that. And the other thing is that a lot of customers phoned me and said, hey, we're really worried about this, so we're looking at other LLM options. But Microsoft's a good option too, because they have a license for the technology. The point is that so many people were surprised, they're now de-risking to make sure that they're not solely exposed to OpenAI for all of their AI technology needs. I think that's a story in and of itself, and that maybe we'll see a more competitive marketplace for all these companies that's doing very similar things.
Still trying to clean up this mess. Ed, thank you, sir. Great work this week. Mandeep, to you as well. Mandeep Singh there of Bloomberg Intelligence for all this talk about mess, Microsoft at another all-time high. The broader equity market about 22 minutes into the session, positive by 0.4%. The Nasdaq up by 0.6% with some sector price action. Here's Abby.
It's a broad-based gain, John. We have most S&P 500 sectors trading higher. The top is communication services and then discretionary technology in there too. Technology is interesting because it's being pulled on by that all-time high in Microsoft, and yet we have NVIDIA at this point down 2.8%. The worst sector, energy, down 1.4%, aligned with oil. Let's take a look at NVIDIA, though, and the reason it's down on the day, most likely. The tech sector, the stocks, both up about 50%, and then there's NVIDIA, even with today's decline, up 232%, price to perfection. Great quarter, blowout, but not enough of a blowout relative to the previous blowouts. Right now, NVIDIA down 3.3%.
Abby, thank you. The energy story, and thanks for flagging it. We're down about 3% on the month for energy, given the broader equity market is up about 8+. Real underperformance there. Crude lower by more than 4%. So we got Brent in the 70s, WTI at about 74. Coming up, it's a pretty light calendar going into the weekend. I'll bring you some of the events you need to be looking for next in our trading diary.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
It's quiet out there, so far at least. 26 minutes into the session, up a third of 1%. Let's get to the trading diary, what you need to be looking for this week. UMich Sentiment Survey, top of the hour. Thursday, US markets close for Thanksgiving. Friday, US manufacturing PMIs, and markets close early for Black Friday. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Have a very happy Thanksgiving and enjoy the family, because ultimately, nothing else matters. From New York, this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Bobby Ghosh, Bloomberg Opinion. He's got a smart voice on this potential hostage deal between Israel and Hamas. And then Matt Winkler, the founder of Bloomberg News, he's got an interesting column out today saying, hey, the economy's in pretty good shape. It's better than you think. And then Robert Teeter, Managing Director and Head of Investment Policy at Silvercrest Asset Management, is going to give us his market call here. So we got a busy first hour coming up, and we're going to kick it off with Mr. John Tucker in a Bloomberg Business Flash.
All right, Paul, we're data dependent, and we have data just out, care of the University of Michigan. I'm going to say it's not Fed friendly. This is the inflation expectations, one-year inflation expectation coming in at 4.5%. We expected 4.4%. The 5 to 10 year inflation expectation coming in at 3.2%. The expectation was for a little lower than that, 3.1%. The reason this matters is because these inflation expectations, they tend to be self-fulfilling. The immediate reaction with the 2-year yield up 2 basis points. So right now that is at 490. As for stocks, S&P 500 rising right now for a 6th day in 7. 8 of the 11 major industry groups, they were higher. Communication services, the biggest gainer, biggest drag from energy, as the OPEC Plus meeting could be in disarray. And then you have shares, of course, of NVIDIA right now. They're down 2.8%. They blew past Wall Street estimates, but failed to satisfy the loftier expectations. And right now, Jack Caffrey at JP Morgan Chase says, you know what, still stocks can push higher.
The holiday rally is certainly very much in force. November has been a really good year. With the end of, say, tax selling, with the return of the corporate bid, with earnings actually now being positive year on year, you have the ingredients of the next, call it month 2, 3, of things being able to, I think, move a bit higher.
And right now, the S&P 500, 9 points higher, up 0.2%. 45.47 on the index. The Dow Jones Industrial Average up 73 points. The NASDAQ 100, 49 points higher, up 0.3%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
John Tucker, thank you so much. We appreciate that. It is Molly Smith sitting in here for Matt Miller, who's on paternity leave. Good morning, Molly.
Good morning, Paul. How's it going?
Very
Happy
well.
Thanksgiving.
Very well. Molly is our economics reporter, but as I just explained to Tom Keene, she is the absolute expert on all things professional tennis here at 731 Lexington Avenue, the headquarters of Bloomberg. So if you have any tennis questions, definitely send them to Molly.
Yeah, we'll find a way to maybe weave it in. Next 3 hours, we got some time.
Absolutely. So Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so just head over to youtube.com and search Bloomberg Radio. As John Tucker was just reporting, got a little bit of green on the screen here. Let's see what's happening underneath the hood with those markets. We do that with Alex Semenova. She's an equities reporter for Bloomberg News, joining us live here in our New York studio. Alex, good morning. What are you looking at?
Good morning. Happy Thanksgiving, guys.
Likewise.
Great to be on with you, as always. Let's start with none other than some of the big tech names that are in the spotlight today. Microsoft is up about 1%. That's after OpenAI said that it would bring back Sam Altman and overhaul its board and bring on new directors, including former Treasury Secretary Larry Summers. This is a big win for Microsoft, the biggest backer in OpenAI, which of course has been working with investors these last few days to reverse Altman's firing. Still not quite clear why it happened in the first place. Obviously, a lot of reporters have been on top of this, but there are questions around why he was even fired to begin with. Jefferies said that the announcement is one of the best possible outcomes for the software giant. They think that the management situation will blow over and it won't have much of an impact on Microsoft. Wedbush said that with Altman back on board, an impressive board is in place, and Microsoft is now in a better spot.
You know, it's interesting. Mandeep Singh from Bloomberg Intelligence, our senior tech analyst, he takes a much more cautious outlook here. He says this is still a bad development and a bad situation for OpenAI in that its customer base has to now say, gee, how invested do we want to get with OpenAI? I mean, as opposed to some of the competitors that might be out there. So Mandeep is suggesting, I know Dan Ives at Wedbush is extraordinarily bullish on kind of Microsoft and its position here, and OpenAI. Exactly. Dan is very bullish, and he's been very right during his career, so certainly give him the credit there. But Mandeep taking a little bit more of a cautious view there.
Yeah, I think that's reasonable. I mean, given how many questions there are about what was even going on.
Yeah.
Sure. I mean, we're talking a board of 3 people for now. I mean, and obviously this is temporary. There's going to be, a fuller board coming in as well. So we'll have Mandeep on later in the show to get a bit more of the breakdown. You said, Alex, you're also looking at NVIDIA this morning. That's right?
Yep, exactly. So shares are now down about 3%. It was up in pre-market, down as much as 6% in late trading yesterday, immediately following the earnings results. Investors are having a cool reaction to this latest report, which did blow past analyst expectations, but it obviously failed to satisfy the very lofty expectations of some of the shareholders who have really bet heavily on AI. Revenue in the current period will be about $20 billion. That topped the average Wall Street prediction of $17.9 billion. So again, quite above that number, but some projections reach as high as $21 billion. So NVIDIA obviously had another great quarter, but the bar was just so high going into these results.
How about our good friends Deere and Company? When I think of Deere, I think of the American farmer. It's kind of a nice litmus test of how the farmer's doing. What do we hear from Deere?
Yeah, exactly. So moving away from big tech and looking at Deere, down more than 5% today. That's after the tractor maker forecasts smaller than expected profit next year with slowing equipment demand from farmers. This marks the change from the outlook that they gave 3 months ago. Previously, they said that government spending on mega projects would benefit them in 2024 and maybe even 2025. But now sliding crop prices have really hit machinery makers in recent months. So Deere is taking a big hit on that today.
What do you make of the trading levels so far, Alex? Would think that this week's probably pretty thin with the holiday. Is this like any of these moves, you think it's still valid, what we're seeing out there?
Yeah, I mean, definitely a very light volume today, given that a lot of people have left their trading desks or getting ready for Thanksgiving. But what we're seeing in big tech is kind of a theme that has been emerging after, the lockstep moves that we saw in the first half of the year. Now investors are treating tech with a little bit more scrutiny, really assessing their earnings results a lot more closely and seeing what they're reporting. You can see that with NVIDIA today. It's not just the AI euphoria anymore. They actually want these companies to deliver on what they were saying previously.
Hey, in the for what it's worth category, Apple breaches $3 trillion in value again as tech rally extends. Yeah, so it's I guess it's the first time since August.
Yeah.
So I mean, you think about the AI situation and what that's meant for tech over the last few days, and here's Apple just cranking along.
Everyone has been so worried about the staying power of tech, but it keeps powering on.
All right, on my walk home to Penn Station today, I'm going to walk past the Apple store on Fifth Avenue and just get a look.
Maybe a little Black Friday?
Actually, I'm going to get a little sense of the economy.
Friday deals? Does
Apple ever have deals, actually?
Probably.
I don't think so. But, you get a look, you just take a look and get a sense of kind of what it looks like these days. Now, I live across the street from the Short Hills Mall in New Jersey. Friday, it will be just packed. Yeah. People who can't get a parking spot. I'm like, I know it's not as big as it used to be, but it's still a thing, I think.
It certainly is.
All right. Alex Semenova, thanks so much for joining us. We appreciate that. Alex Semenova, she covers all the markets for Bloomberg News. All right, let's flip gears. Let's head back to the geopolitics of it all and the impact it has on the market. The news coming out of Israel that I'm reading out on the Bloomberg terminal here, Israel and Hamas agreed to a short truce for hostage release. Hamas agrees to free 50 hostages, possibly more in days ahead. The deal would mark the first lull in the war since the attacks on October 7th. So I guess, if nothing else, that in and of itself is probably some good news. Bobby Ghosh joins us. He's an editor with Bloomberg Opinion. He joins us live here in our New York studio. Bobby, I mean, just to me, it feels like good news, maybe a little bit of thawing here. How do you read it?
I wouldn't go quite so far as to say there's a thaw. It is good news.
Okay.
Look, it's great news for the hostages and their families. It gives ordinary civilians in Gaza a break from the bombing. It's a cessation of hostilities for 4 days. And Israel is already saying, Prime Minister Netanyahu is already saying, moment that ends, we go back to bombing Gaza. We go back to fighting Hamas. So there's, you know, it's not really a thaw. It's a deal that was struck in Qatar with very strong pressure from the United States on all parties to make this happen. And we should thank God for small mercies, as they say. And as I said, for the people who are benefiting the most from this deal, the mercies are not small. They're quite substantial.
Absolutely. We're seeing 50 hostages from Gaza will be freed, and the release of 150 Palestinians who are in Israeli jails at the moment. But tell us, Bobby, because this is exactly what Israel has not wanted, in the sense that any pause is a chance for Hamas to regroup, get the military operations back together. I mean, this is that something to be feared then, that like there could really be maybe an escalation in the violence after this?
I think this is why it's taken this long for the truce to happen. Israel had to be absolutely certain that the chances of Hamas regrouping and rearming were as small as possible. I mean, there's always that possibility, but Israel would not have made this deal if it didn't have a high degree of confidence that it can prevent that from happening, or it can manage how much Hamas rearms. Presumably, this means it'll be paying much closer attention to the borders, much closer attention to those tunnels through Egypt to make sure that Hamas does not get it. And it has already wrought so much damage on Hamas infrastructure that there must be a high degree of confidence that, you know, Hamas's arms-making facilities in Gaza City, for instance, will not easily be revived in 4 days.
Okay, so that's kind of where I wanted to go, because I know that the stated objective of Israel is to destroy Hamas and its leadership.
Yeah.
How do you define that? How do you know when it's happened? I kind of fear it's like the drug cartel. You take out one kingpin, and then the next person just rises right up again.
Yeah, this is not they're not fighting a conventional military. Right. This is a terrorist group. And, you know, the leadership can change and has changed. Israel has a long history of taking out top Hamas leaders. The thing just keeps coming back. And you also have to remember that in the process of trying to eliminate Hamas in this way, it's also creating the circumstances for Hamas to be able to recruit. Yeah, you've got hundreds of thousands of young Palestinians in Gaza and elsewhere who are outraged by what they see, and a small proportion of that population will be more amenable to joining Hamas now, shall we say, than they were before. So it's, you know, this is not the kind of war which ends with people signing an armistice and making a peace deal. And that's been the problem. The Biden administration has said consistently from the beginning that they've been asking the Israelis to define what victory looks like and explain what happens the day after. And until now, the Israelis have not provided that information. They've not communicated it in private to the Biden administration. They certainly have not communicated it publicly.
And of course, whatever that timeline may be as well is probably pretty daunting to think of, like the task ahead, how long that may take. Makes me wonder if there could be perhaps the need for more ceasefires in the time to get to that endpoint.
Yeah, so we'll see if this one works. And everybody shows good faith, and that then hopefully creates the circumstances for another one down the line and another one, and maybe this is the kind of conflict where, because everyone is so painted into their own corners or the opposite ends of the room, that the advances that can only be incremental. It might be that this is the only way, slow, painful, deadly as it is, this might be the only way we begin to move towards some kind of resolution.
Is there a scenario where Israel does not end up occupying Gaza? I can't think of a scenario where they don't, to preserve the peace. I mean, does the UN play a role? I mean, what do we think about the day after?
Well, so here's the thing. Now, Israel has signaled that it is willing to do that in order to make sure Hamas does not come back. But this is not a popular idea among Israelis,
right?
For a start. Israelis don't want an occupation of Gaza because they know what that will entail, not just in terms of costs, but also the risks that come with that. Nobody else wants to do that. Nobody else wants to perform that role. I don't think any Western peacekeepers would have credibility there. The United Nations will eventually have to play a role, but until now, you know, Secretary General Guterres has been sort of saying, look, this is not going to become a protectorate of the United Nations. The Arab countries who would logically be part of the biggest part of any peacekeeping effort, their view is, why should we clean up Israel's mess? This can't become a thing where you go in and bomb Palestine or parts of Palestinian territories to smithereens and expect us to come and clean it up for you afterwards. So there's going to be a lot of reluctance. The crucial question for everybody is peacekeeping toward what end? If there is a clear path after the fighting is over for a two-state solution, then I can see, and there are sort of cast iron guarantees to that, then I can see the Arab states saying, all right, we'll take some of this responsibility if there's a clear path that this never happens again.
All right, so on that two-state solution, who is the biggest impediment to that actually happening at this point?
I mean, there's so many impediments, and at different times their relative weight changes. But Israel is an impediment. The current administration in Israel, the coalition government that Benjamin Netanyahu has put together, has no interest in a two-state solution. Many of his partners have openly said that's not what they want, that they will oppose it. The Palestinian Authority, which is deeply corrupt, completely inept, and has not dared to test its popularity with an election in years and years and years, they are an impediment. And of course, Hamas. And Hamas's enablers Iran is a very big part of the peace problem too. So yeah, a problem this intractable and this complicated, there are lots of people who have to share the blame.
Just really quickly here, Bobby, in our last 30, if you could just explain to us what this second stage could look like with a possible extension to free more hostages.
Well, so there's some talk that after these 50, if Hamas continues to release hostages in a sort of steady, sort of 10 a day, 15 a day, then there's some hope that the cessation of hostilities, the truce, can be extended. Again, this is something we should all hope for and keep our fingers crossed that it happens, but we'll believe it when it happens.
Yep, absolutely. All right, Bobby, thank you so much for joining us. Bobby Ghosh, he's a columnist for Bloomberg Opinion. He's got a tremendous amount of experience in international affairs reporting, certainly in that part of the world over there in the Middle East. We appreciate getting a few minutes of his time here. Looking at the markets here, holding on to some gains here. The S&P 500 is up about 0.2%. NASDAQ up about 0.25%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. NVIDIA investors weren't blown away with the chipmaker's latest quarterly report, which topped estimates, but failed to satisfy shareholders' expectations. Bloomberg Intelligence senior tech analyst Mandeep Singh pointed to a data center expansion.
Data center IT market was about 8 to 10% grower historically, and when you look at the numbers that NVIDIA is printing, clearly there is insatiable demand. Yes, they will be affected by China restrictions, but they're still under shipping demand, and that was the message.
Now we have shares right now down about 4%. After intense pressure from investors, Sam Altman is coming back as CEO of OpenAI, and the board is going through a serious overhaul. Sources say Microsoft, who hired Altman when he was let go from the ChatGPT parent, is likely to have representation on that new board. Now, Bloomberg's Alex Webb explains why this could be an issue.
One of the reasons Sam Altman was ousted was concern that he was prioritizing the commercial impulses of the company over what actually is his mandate, namely to improve, and this genuinely is the wording, it is to work for the benefit of all humanity. Now, Microsoft is almost certainly going to be getting greater oversight, greater sway at a board level over what happens at OpenAI. The company is therefore going to be run ever so slightly more in the interest of Microsoft, not necessarily in the interest of all humanity.
Microsoft upped a fraction. And the interim board will be led by former former Salesforce co-CEO Brett Taylor, Larry Summers, the former Treasury Secretary, now Harvard professor and paid Bloomberg contributor, is getting a seat as well. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Investors still digesting NVIDIA earnings and a fresh batch of economic data ahead of the Thanksgiving Day holiday. Volume right now a little light. That could exaggerate some of the moves. And oil extending declines. It was the OPEC Plus meeting that had been set for the weekend. That has now been delayed. As a result of that, in the commodity space, we have NYMEX crude right now down $3.50. That is a 4.5% decline for WTI. At the top of the hour, the data from the University of Michigan showed short-term inflation expectations climbing to an 8-month high. That has pushed yields higher. We have the 10-year up 2 basis points. That's at 4.41. The more policy-reactive 2-year yield, that is 4 basis points higher. That is at 4.91%. And Apple, the world's most valuable company, rising to push its market value above $3 trillion for the first time since August. S&P 500 right now 14 points higher. That's up 0.3%. Dow Jones Industrial Average up 110 points. The Nasdaq 167 points higher. That's a rise of 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
So, John, I mean, just confirm that you have traded in the flip phone for an Apple product?
Actually, the only reason I do now have this brand new Android phone.
Android? Ooh, look at you.
Wow.
Bucking the trend.
I dropped the other one in the toilet.
No, you didn't.
Yes, I did, and I didn't want it back.
That's probably more than we needed to know, don't you think, Molly?
All right, thanks for sharing.
Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check that out. I don't know. I mean, if you look at the polls, if you just think about how the media is portraying the economy, people out there kind of feel like the economy is not doing well, but the numbers don't back that up. And we even had some jobless claims today that came in better than expected. And that's the subject of Matthew Winkler's most recent column. Matthew Winkler, I think he's in the news business or something. He founded this thing called Bloomberg News many, many years ago. He's our editor emeritus at Bloomberg News, and he joins us here in our Bloomberg Interactive Broker studio. Matt, I know you and your team, you love to look at the data. What's the data telling you about this U.S. economy here?
Well, it's always good to be with you. Under Joe Biden, when he became the 46th president, the unemployment rate never had fallen so far, so fast, settling at the lowest monthly average since data was compiled in the 1940s. And then in a span of less than 18 months, inflation, which, as you know, everybody has been worried about, has slowed at a rate never seen before. And then there's gross domestic product per person, okay, per capita. And that increased almost 18%. And we haven't seen that in this century. And that's more than 3.5 times the average, according to data compiled by Bloomberg. So the polls tell us voters are unhappy. Never mind that manufacturing jobs increased 2.2% each year under Biden, after declining at a 2% annual rate since 2000. The ratio of household debt to GDP fell to the lowest since 2001. And personal income not only rose at an annual rate that's above the century's average, but it's also the fastest rate of any presidency in the past 23 years.
So what gives here in terms of the polls? Because I think this is a political challenge for him as he comes up to the election here.
Well, my favorite go-to, if you like, authority journalist is George Orwell. And, you know, he famously said something that just continues to be so relevant, which is to see what is in front of one's nose needs a constant struggle. Okay? And that's really what we're talking about here. If you go to the same polls that say Americans don't like the economy, and they ask the question, how are you doing? Well, the answer is overwhelmingly well. Okay? So the same polls where people say the economy's terrible, but I'm doing great. And by the way, that's backed up by something else, which is very definitive. The Federal Reserve last year in May published the economic well-being of U.S. households. And it was a very detailed survey of 21. And by the way, we're better than where we were in 21. And it found that 78% of adults were either doing okay or living comfortably financially. And that's the highest share that has ever been in this survey since it started in 2013. So you put all that together, actually, the answer is right in front of us, which is we make a mistake when we talk about the polls, omitting the key, if you like, detail. It's very important. You ask everybody how they're doing, and they say, I'm doing fine. So that kind of undermines this whole notion that the economy is bad.
That really gets at the heart of this phrase that, you know, I covered the economy here, and like we often talk about this among the team, that this idea that inflation affects everybody, but unemployment only affects your neighbor. And if you are somebody who still has a job and are still earning an income, life is still pretty good, right? I think is that kind of like the disconnect here?
Yeah, well, not only is life pretty good because you have a job. I mean, the unemployment rate right now, averaging below 4% month after month. I mean, you have to go back to when I was not even an adolescent to find that kind of an economy. That's the early 60s, really, for something so robust. But then on top of it, this whole notion of inflation. You know, I live in New Jersey, as you know, and I could get gasoline at the pump for $2.95 a gallon last weekend. And it's probably going to go lower, by the way. You know, I could buy, I couldn't believe this, a carton of eggs, 18 eggs for $1.99, okay? That's a pre-pandemic price, okay? So this whole notion of, oh, inflation is elevated, well, yes, it is, without question, in the housing market. But even when you look at rent today, rent is decelerating at a faster rate than we've seen in quite some time. So these are all very positive indicators, and your next door neighbor should feel pretty good about where things are.
I'll have to ask her, but you know, this is the thing though about, like, you know, you mentioned rents decelerating, that this is like what gets at, for us, you know, the heart at why so many people will say the economy is so bad. Because even though inflation is easing, prices are still rising. I know you just mentioned gas and eggs, and that those are some prices that are lower today, maybe relative to a pre-COVID level, but a lot of other things are absolutely more expensive.
Right, but if you wait long enough under Biden, it all gets better. I mean, that's the whole point. I mean, a year ago, we were all talking about how terrible inflation was when it came in at 9.1% in June.
Right.
And now it's very, very close month by month to exactly where the Fed wants it at 2%. Okay, if you look at the past month over month inflation numbers, it was 0, by the way, most recently. So that's why I say, if you wait long enough, the Biden economy just gets better. And by the way, speaking to your point about housing, let's talk about the bond market, okay? You guys have been reporting lately about this ferocious rally. The headline today is about the 2-year is dipping below 5%. What does that tell you? It tells you that a lot of people in the market's a pretty good place to go to for a reality check, 30 trillion U.S. government bonds, held widely around the world. And people think interest rates probably peaked. So if they have peaked, then mortgage rates are going to come down. Mortgage rates coming down is going to spur housing purchases, et cetera. That's why I say if you wait long enough, it will get better.
You really should craft Biden's re-election campaign here, because this is what he's struggling to get something to people.
I think so. If you were part of the Biden campaign, I mean, hopefully they're going to read this column today and create a little, slide deck for every American. But this is going to be a challenge for President Biden. Is this a messaging issue for him and his team?
One of the people I've admired for quite some time is Joe Stiglitz, who's a Nobel Prize-winning economist. And he recently wrote that all of the anxiety that was generated and the publicity about inflation was kind of misplaced. His title is A Victory Lap for the Project Transitory Team. Remember, we all ridiculed even Janet Yellen for using that word transitory. But if you look at how much inflation decelerated and that it's still declining, you got to give Joe Stiglitz some credit here, because he got it right when he says, what we were talking about that back then were fears, and the fears were amplified, not the actual fact that inflation was out of control.
Just one thing I want to touch on with you, Matt, here before we let you go. Measures of consumer confidence and sentiment are still very low, below pre-pandemic levels. How do you square that with some of the other measures of optimism that you point out in your column today?
Well, there's still quite a lot of people, and they're in Congress today, who say Biden lost the election, that he won by 7 million votes. Okay, that's almost the entire Republican Party in Congress today saying he lost. Okay, so when you have that kind of political polarization applied to something as important as an election, you can see how it can infect every other discussion, including the economy. So that's why the polls are not necessarily a leading indicator or a reliable indicator of our times.
Don't we know it?
Yeah, exactly. Matthew Winkler, thank you so much for joining us. Matt Winkler, he is the editor-in-chief emeritus at Bloomberg News, the founder of Bloomberg News way back in the day, and he's got this column out. You can check it out at OPINGO or Bloomberg.com/opinion. You can find all of the really, really good opinion stuff we've got out there for Bloomberg News. Right now, let's head down to New York City. Michael Barr with our news.
Thank you very much. It is a breakthrough for hostages held by Hamas in Gaza. After more than 6 weeks of fighting, Israel and Hamas have agreed to a deal that would free about 50 hostages, women and children, in exchange for 150 Palestinian prisoners, women and minors, and a 4-day ceasefire. Israel Defense Forces spokesman Peter Lerner said fighting will resume once the temporary truce has ended.
We will be in our positions, we will be standing strong and prepared, because we know Hamas have a dubious record with regard to holding fire in the past. They've utilized these types of pauses in the past to conduct more killing and abduction.
Israel Defense Forces spokesman Peter Lerner spoke to British broadcaster Sky News today. The Pentagon is confirming it conducted an airstrike against Iranian-backed militants operating out of Iraq. Bloomberg's Ed Baxter has the story.
The Pentagon says it was in response to several short-range missile attacks. Pentagon spokeswoman Sabrina Singh.
Immediately following the attack, a U.S. military AC-130 aircraft in the area conducted a self-defense strike against an Iranian-backed militia vehicle and a number of Iranian-backed militia personnel involved in this attack. This self-defense strike resulted in some hostile fatalities.
Singh says some U.S. service members were injured in the attack. She also says the U.S. conducted 3 additional strikes in Syria. Ed Baxter, Bloomberg Radio.
Millions of people are expected to hit airports in record numbers over the Thanksgiving break. This man admits, though, it costs more to fly home this holiday.
I think my ticket here round trip was like $450, and usually I fly home for around $250. So, yeah, I would say it's definitely a little more pricey.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. It is Bloomberg Business Flash. The S&P 500 pairing earlier gains. We have Treasury 2-year yields. They are up right now to 4.92. That's a 5 basis point rise after the data we got at 10 o'clock. The short-term inflation expectations for the University of Michigan climbing to an 8-month high in November. So that's not exactly Fed-friendly. Microsoft, that's advancing on news that Sam Altman's going to return to lead OpenAI, their partner. NVIDIA still dropping after its results. The results were pretty solid, but investors were left wanting even more. NVIDIA shares right now down 2.8%. Then we have oil tumbling after the OPEC Plus meeting has been delayed this weekend. At Capital Economics, Neil Shearing sees recession for some parts of the globe ahead.
I think we probably will meet that definition. I think that's a very real prospect in Europe and indeed the UK. Perhaps less of a threat in the US, perhaps a bit more 50-50 in the US. But certainly I think we're going to be entering 2024 on a substantially weaker footing.
Right now, the S&P 500 up 22 points. That's a rise of 0.5%. We're at 4560 on the index. The Dow Jones Industrial Average is up 139 points, a rise of 0.4%. And the NASDAQ 100, 0.7% higher. That is up 110 points. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate it. Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. So head over to youtube.com and take a look at Bloomberg Radio on your search. Bloomberg is also now in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, first of all, it's free, so it's right up John Tucker's alley there with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers, so we thank them. All right, I don't know what we do with these markets. I mean, I've been long Magnificent Seven. I don't know what the rest of the world's doing, so I'm happy as a clam, but what do working people do? I mean, Molly, you haven't been in there. Tom's in the triple all-cash leveraged all-cash fund. But let's go to a professional who does this stuff for a living. Robert Teeter, Head of Investment Policy and the Strategy Group for Silvercrest Asset Management, joining us live here in our Bloomberg Interactive Broker studio. Robert, for those of us that have been in the Magnificent Seven, life is good. How about the rest of the world? What are you telling your clients here as we finish out this year and think about 2024?
Well, our main message is to be patient. So that Magnificent Seven is starting to broaden out in the past few weeks. We think that coincides with the turn lower in interest rates starting in late October. I think that's an encouraging message. And as we look ahead to next year, we see a slow growth economy, decent earnings backdrop, and perhaps improving valuations. So we're saying it's not particularly exciting, but it's not very scary. So let's be patient and allow the market to broaden out a bit. Let time be your friend over the course of the next year.
I wanted to follow up with you on this. You told us before the show that you're expecting 2024 payrolls to expand at a similar pace to this year, which over the past 6 months has averaged 206,000 a month. That doesn't sound like slow growth to me. That would be a slam. That'd be incredible.
I think it's been consistent with, sort of roughly 2% growth, which is about what we're looking for. If you look at the size of the economy now and just sort of grow jobs by about that same number, 2% or so, you get to a spot where you're just south of that number. So I think it will trend down over the course of the year a bit. But when you see the postings still remaining high and JOLTS still up over 9 million, you're still seeing pretty decent wage growth. It shows there's good demand for hiring. We think that number hangs in around 200 for most of the year.
All right, so Robert, we just kind of finished up on the third quarter earnings season here. What did you take away? I mean, it seems like the numbers themselves are okay, but I guess understandably, the management's just pretty cautious in kind of their outlooks.
I think understandably, there has been a lot of caution, and I think that's on the face of a slowing economy. So we had, very strong growth in third quarter. We're looking for that to downshift a bit, so it makes a lot of sense that companies are guiding on the cautious side. But the other takeaway, and I think it's a really important part of where earnings will come from next year, is on the margin side. So we continue to see stories of deployment of technology, whether that's robotics or in AI, with regard to cost controls. And so with a slower economy, you're going to focus a lot more on efficiency, and implementation of those technologies, I think, has a lot of impact on margin and where earnings will come from next year.
So when we talk about margins, a lot of that is also how easily a firm can pass on its costs to its customers. And seeing with inflation easing, that's not obviously nearly as easy to do as it was, say, a year or so ago. So, I mean, where are we at with that right now, and how firms really can pass these costs along?
Yeah, I think for better or worse, that's normalizing. So, a lot of those changes in prices, some of the inflation goes to, one company's revenue, and some of it goes to another company's expense. I think we're getting to a more normal backdrop now. And I don't think companies are looking for a lot on the revenue side. And I think that speaks to the caution that they've referenced on the outlook. And so I do think they'll be looking to efficiency and really fine-tuning those margins to eke out earnings gains next year.
So I'm looking at the work function and the market. I don't know. I don't have as much faith in the work function as I used to.
It's a scary function.
It's a scary function.
But that's the world interest rate probability.
Right. Thank you.
For
and it's
anyone who's
looking
listening.
for interest rates, the Fed to cut rates next year. But I still hear the Fed talking tough here about higher for longer. How do you think rates are going to trend next year?
So I'm a big fan of the work function, perhaps not quite as scared of it. I think it's been leading the 10-year pretty well in terms of a year forward on the rate side. I think the Fed's smart to remain tough in their talk. They don't want to let up until after the job has been done, and we've only seen a couple of signals from them as to what would lead them to cut. And the main one is based around real rates, and if we can get inflation below 2.5%, they might be in a spot where they can cut a little bit and still keep real rates pretty high. So I don't look for anything dramatic either, but I do look for cuts in the back half of the year, mainly on the basis of just reflecting declining inflation.
So it sounds like I'm going to take a stab at this, that you're in the soft landing camp here.
I am in the soft landing camp. I'm not expecting a recession. I think that view could change, of course, if job growth stalls or we see job postings decline a lot or see weakness on that front. But I think just continued growth in payrolls is what will lead to minimal growth on the economic side.
All right. So what sectors are you guys looking at? I mean, a lot of folks are saying maybe take a look at some of the the growth stocks that were not in the Magnificent Seven, and maybe try to find some of the laggards here. Other folks are saying just double down on the ones that are working. I guess those are momentum investors. I'm not sure, but where are you guys looking as you think about next year?
Yeah, next year I think is going to be difficult on a sector front, mostly because I think a lot of it comes down to implementation and margins more than any particular sector leading, especially with a slow growth backdrop. But I do think the broadening out will continue, as rates head lower, and if WIRP's close to right and rates are coming down by 100 basis points, that should help small cap a lot. And I think small cap could be a really interesting area of opportunity.
Really? Now, the small caps, I mean, I saw a couple of good days with the Russell. We had that kind of the rally last few weeks, and the Russell had some nice movement. It's up about 0.9%, leading the market today. Is that kind of how you're thinking about it? I mean, those types of companies?
Yes, and we've seen that play out in the last month, and I think that's sort of a preview of the year to come. And I think a lot of the weakness in small cap has been on the funding side and just fears of higher for longer being a really difficult funding environment for smaller caps that tend to have weaker balance sheets than the Magnificent Seven. But as that funding backdrop gets a little easier next year, rates come down a bit, that could benefit.
How are you thinking about the bond market right now and where you'd be best positioned along the curve?
Yeah, I think it's a really interesting and compelling backdrop for bonds here in that if you're staying high quality on the credit side and you've got a backdrop where rates are headed lower, that's pretty compelling. And so again, I think in the short term, it sort of requires a little bit of patience because those cuts aren't coming anytime soon. And I think the level we've settled in on the 10-year around 4.5 feels about right for now. But looking ahead over the next year or so, I think taking a little duration risk makes some sense.
What's your biggest risk in the market, do you think, right now?
Yeah, so I think the combination of an election year cycle next year and still some brewing geopolitics around the globe is something that could be an exogenous event that knocks us off on the valuation side.
Anything maybe in the war in the Middle East, if that's on your radar?
Yeah, absolutely. I mean, that adding into the equation, as I have been saying to clients, sort of doubled the geopolitical risk factor. You went from one conflict to two. Thankfully, things have sort of been digested by the market reasonably well here, but anything could flare up again, and that could be a potential risk factor.
Robert Teeter, thanks so much for joining us. Robert Teeter is the head of investment policy and strategy at Silvercrest Asset Management. Appreciate him coming into the studio when so many of my Bloomberg brethren are not coming into 731 Lexington Avenue. And I'm taking notes. Trust me on that. So we appreciate that. S&P 500, we're up 0.4%. The Nasdaq's up 0.6%. So we got a little bit of strength here on this pre-Thanksgiving Wednesday. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Binance, the world's largest crypto exchange, has pleaded guilty to anti-money laundering and also sanctions violations. Now, the company will pay $4.3 billion, and its CEO, Changpeng Zhao, or CZ, will step down and pay $50 million fine. Brian Armstrong, CEO of Coinbase, called the resignation an opportunity for the crypto industry to start a new chapter.
It's not only been, I think, an opportunity for Coinbase to step in, but it's also an opportunity for the industry, I think, to turn the page here and say that, yeah, some of the rules are clear around AML, KYC, OFAC, that the issues that Binance really had stepped over the line on. But some areas of the law are not yet clear. We need to go get that regulatory clarity to make sure that the future of this industry is built here in America, not on offshore unregulated exchanges.
To earnings now, where Deere, the world's largest tractor maker, predicts a smaller than expected profit next year as demand from farmers slows. We get more from Bloomberg's Isabel Lee.
Farmers are now less willing to buy equipment because they're squeezed. Their budgets are smaller, higher borrowing costs are really deterring them. And if this decline holds, Deere is on track for its biggest fall since April, and the company is on track to shed more than $6 billion in market cap.
Deere right now down more than 5.5%. And some tough news for Tesla. A Florida judge has ruled that a Tesla driver's family can seek punitive damages over a 2019 fatal crash that was blamed on autopilot. The judge cited evidence that shows CEO Elon Musk and staff engineers knew that its driver assistance system was defective. A trial date has not been scheduled. Shares right now of Tesla down 2%. Those are the company stories we're following. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, the S&P 500 up 0.3%, NASDAQ up 0.4%, and again, calling out Russell 2000, the small cappers up about 0.8%. So that's the broadening out of the market, if you like, that Robert Teeter, our recent guest, was just talking about. WTI crude oil off 4.3%, $74.42. A gallon of gasoline, $3.28 nationally. If you're on Route 36 in New Jersey, you could probably get it to Wawa.
Yeah, it was $3.30. Matt was saying it's under $3 in New Jersey, in his neck of the woods.
Yeah,
I got to find $2.99. Where?
We'll take a look at
and
that.
our producer saying he paid
$3.05
$3.05 at Costco last week.
Right, exactly. All right. With our news in New York City, here is Michael Barr.
Paul, Molly, thank you very much. Israel and Hamas have reached an agreement on a 4-day halt to the devastating war in Gaza and the release of dozens of hostages held by the militant group, as well as Palestinian prisoners. The truce marks the biggest diplomatic breakthrough since Hamas's October 7th rampage into southern Israel. 50 hostages will be released in stages in exchange for what Hamas said would be 150 Palestinian prisoners held by Israel. Meanwhile, Pope Francis is calling for peace and an end to terrorism after meeting at the Vatican today with relatives of Israeli hostages in Gaza and Palestinian prisoners in Israel. Alexandra Ariev is the sister of 19-year-old Karina Ariev, a corporal stationed at a base at the border with Gaza.
She's my only sister, and she's all I have in this world. She was kidnapped from her bed in her pajamas.
The meeting was arranged before the Israeli-Hamas hostage deal. The holiday rush ahead of Thanksgiving continues. The TSA expects to have screened more than 30 million air passengers by the time the holiday travel period is over. Some travelers decided to take the train instead.
I've been spending money on planes for a while, and we thought, okay, let's book a flight, and it was astronomically expensive.
Americans are also hitting the roads today. Drivers in major metro areas are expected to see average travel times up to 80% longer than usual. Pet owners are being warned to be on the lookout as a mysterious respiratory illness affects more dogs across the country. Vets say it can last for weeks, possibly leading to pneumonia and even death. Veterinarian Lindsay Ganser.
Typical signs are starting with a cough, eye or nasal discharge, progressing to more of a wet cough, lethargy, fever, not wanting to eat.
The disease has now been reported in 12 states. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Molly?
All right, Michael Barr, thank you so much. We appreciate it. Coming up in the next hour, Sri Kumar, president at Sri Kumar Global Strategies. He's going to join us to give us his thoughts about the economy, maybe where this Federal Reserve is going. Here's an interesting story. I know you're in the market for a home in New York City, but some of the most expensive major cities in the U.S., Molly, like San Francisco and Washington, also offer the best living standards for mid and lower income households. That's according to a new study by the Ludwig Institute. Higher prices in those places are more than offset by the higher wages on offer, according to the Institute's analysis. So, yeah, it's expensive to live there, but people tend to make more money. So I know you're in the market to buy some real estate in New York.
Notice how they did not say New York is one of these places
that
that
they call
offers.
out San Jose, Austin, San Francisco, Baltimore, Washington. But you're not looking for an apartment there, are you?
No, I'm trying to stay in our great big city here, very close to HQ.
And how is the market?
It's tough. I hate to say it, but the 1 million price range is what is considered the low end here. Wow. So,
and that's for a 1-bedroom,
yes,
right?
Thank you for reminding
$1
me.
million, 1 bedroom. Wow. Rest of the nation is now going, what?
Yes, $1 million for 1 bedroom, 1 bathroom. Can't get much better than that.
And there's not a lot of them, right?
No, the inventory,
right?
There is, but that's what we're hoping that, as these mortgage rates start to come down, more sellers are going to be encouraged to put their homes on the market, and maybe we'll get a bit more supply coming up. So that's the hope.
All right, there we go. There's the little real estate report there for you for the Upper East Side of Manhattan. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Mandeep Singh, Senior Technology Analyst with Bloomberg Intelligence, to get the latest on the saga at OpenAI. Seems like Sam Altman, he's going to return as CEO. How about that? And then we're going to speak with Sri Kumar. He's going to come in studio. He's the president of Sri Kumar Global Strategies. He's been looking at these markets, these economies for decades. We're going to get his outlook, which is always appreciated. And then we're going to take a look at the market call of Eric Lynch. He's a managing director at Scharf Investments. That's all coming up in this hour. We're going to kick it off as we do with the Bloomberg Business Flash. John Tucker.
All right, Paul and Molly, inflation expectations from the University of Michigan data this morning, they were higher than expected, so that suggests, the inflation fight has not been won just yet, and that's pushing Treasury yields higher. The more policy-reactive two-year yield, 4 basis points higher. That's at 4.92. So that seems to be keeping a lid on any gains in risk assets, any further gains. The fall in rates that we've seen so far this year, that's only temporary, at least according to Alberto Gallo. He's at Andromeda Capital Management.
We're not done here with the call on duration. We're not done. We think we're going back towards where we were previously this year. Maybe not 5%, but we're going back up.
As for stocks, 9 of the 11 major industry groups in the S&P 500 higher right now, with communication services, that's in the lead right now. The OPEC Plus meeting set for this weekend, that has been put on hold, causing some turmoil. Right now, NYMEX crude, that is 4% lower, down $3.10 a barrel at $74.67. And Apple's market value, again, risen above the $3 trillion mark for the first time since August. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, very much appreciate that. Molly Smith, Paul Sweeney. We're live here at the Bloomberg Interactive Broker Studio. We're not mailing it in. We are here in the studio. We're also live on YouTube. So head over to youtube.com and search Bloomberg Radio, and that's where you will find us on Bloomberg Radio. Again, John Tucker, just talking about, we got some green on the screen here. Let's see what's happening underneath the hood there with some individual names. So we turn to Jess Menton. She's also in our New York studio, not mailing it in. Jess, what do you see out there in the equity markets today?
I know how bullish you are about in-office.
Sure.
Molly knows too with the Paul Sweeney. Not just